line in doing the job that he was elected by those members to do, which is potentially why everyone says you see McCarthy yesterday, first day back, going to the podium and without a House floor vote, which he indicated that he would take this to the floor first. He just launched an impeachment probe into President Biden.
I got 8 ways to go here, particularly for our international audience. We don't need a civics lesson on Boehner of Ohio down in flames. You had to get Democratic votes, folks, to get things done as a Republican Speaker of the House. But, Anne-Marie, just cut to the chase. How big is this group of Republicans? Is there a dearth of Republicans in name only in the House?
Well, the issue, Tom, is that every single one of them wants something different. So a member of the House Freedom Caucus, which many would say these are far-right members of the conservative of the Republican caucus, Ken Buck says there's just no evidence right now to go along with an impeachment inquiry. You have others that are more focused on not wanting a continuing resolution. Scott Perry, the chair of the House Freedom Caucus, saying we're not going to go on with a continuing resolution. We want deeper spending cuts. We don't care about the deal Speaker McCarthy cut with the administration when we were discussing this back with the debt ceiling drama. So every single member has some sort of provision they want in order to get their vote to say keep the government open. And that is what makes this so difficult for Speaker McCarthy to navigate.
One of the things that you do best, Anne-Marie, is to strip out the noise from the signal and to focus on what's the political drama, the soap opera, the theater versus what is real. Is it fair to say that the impeachment is theater and most everybody in Washington, D.C. is treating it as such?
Well, it is, because it's an inquiry at the moment, and even if the House was to have a vote on impeachment, there's no way there's going to be a conviction in a Democrat-held Senate. So this is an impeachment to nowhere. It's going to be a ton of theater in the House Judiciary Committee, in the House Oversight Committee, James Comer, Jim Jordan. There's going to be subpoenas for a number of bank records, et cetera. But a lot of this is going to be noise. At the same time, while there's no evidence yet, potentially keeping this in the news, the Biden administration is going to have to deal with it. And so is the campaign, because obviously he's running for re-election in November of next year.
So that's the theater side. And here's the real side that a lot of people are looking at right now, away from the political circus, which is the UAW strike and the potential for some sort of breakdown in negotiations. Goldman Sachs put out a report saying that that a potential strike would reduce quarterly annualized growth by 0.05 to 0.1 percentage point for each week it lasted. This is going to have a material effect on growth. What is the response from the Biden administration, and what is the response from the Republican leadership?
Well, Wally Adeyemo recently said, and he's the one we have this week on the record talking to CNBC, saying that he does not think there'll be a strike. There are still negotiations. But the reporting we have from our colleagues out of Detroit is that they are very far still at this moment, and that Sean Fain by 10 p.m. tomorrow will have plans in place if there is no agreement to go on strike. Maybe not at all three, maybe not at all plants, but a certain number of plants, there will be strikes and walkouts if they do not have this agreement. Between the labor workers, the union, and the big three, they just are not coming in on the hard demands that both sides have laid out. And Sean Fain has said that we are willing to strike over this. This is going to be a difficult position for the White House. The president wants to make sure that he is on the side of the union, but at the same time, he doesn't want to see growth impacted because of this or strikers on the streets in Detroit. And he also wants to, the crux of this is move the auto industry into a greener future. What you saw at the end of last month was $15 billion to retrofit those factories instead of having these companies go to the South and do these joint ventures for battery operations for EVs. And last month, almost a month ago, it would be a month to the date of the contract expiring, the president put out a statement, and he talked about how its union workers should get the first shot at any of these jobs, and there needs to be a just transition, and that union workers should have the wages they deserve to support a family. You could see the line he is trying to walk as he's trying to balance two big goals of his administration.
I'm not sure how he walks this line, AMH, without picking a side. You've got the auto manufacturers in Detroit warning about the sustainability and viability of their companies. as they make the effort to make the transition. How does he carry on walking this line without picking a side?
Well, it would have been easier for him if in the Inflation Reduction Act, what some Democrats wanted, which was an extra bonus tax credit for those who bought electric vehicles that were made by unions. But guess what? Toyota has a huge non-unionized factory in West Virginia, and they were never going to get Senator Joe Manchin's vote on that. This is the predicament for President Biden. At the end of the day, there's going to be a lot of phone calls that are going to be worked between the big three and the UAW. He's already tasked Gene Sperling to be in the middle of this, but so far, there's still no agreement.
Has the president made it harder for himself by continually saying that he is the most pro-union president in the history of this country?
Potentially, if you're going to see a strike, and if the UAW feels like they're getting a lot of pressure from the White House to settle for something they do not want, they can say to the president, well, you're supposed to be backing us. At the same time, really, a big bedrock of this discussion and a source of serious consternation for UAW workers is being left behind in the EV transition. And what we've seen from this administration is the biggest industrial policy when it comes to EVs, climate change, since the end of World War II. And that is why it is so complicated for the Biden administration.
It could potentially be a massive test for his position later this week. AMH, Anne-Marie, thank you. And the position, of course, I'm talking about is the position of someone saying that they are the most pro-union president in the history of this country, Tom. Let's see how the White House responds to a potential strike later this week.
The election's down to 10 states. I'm going to say as an amateur, Greg Giroux at Bloomberg is expert on this, but the bottom line is those states have a tendency towards manufacturing Rust Belt and even the romance of it, the look back, the image, the heritage. And so he plays to that, and so does Mr. Trump as well.
AMH, thank you. As always, down in Washington. Coming up shortly, Megan Robson of BNP Paribas on the credit market. Plenty to discuss there. And we've had a ton of supply issuance from corporate America through September so far. Your equity market slightly negative on the S&P 500. We're down by 0.1%. Inflation data in America 1 hour and about 4 minutes away.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Inflation data in America 60 minutes away. Going into it all, your equity market looks like this. Good morning to you. Futures on the S&P 500 slightly negative by 0.1%. Similar move on the Nasdaq, softer, lower, negative by 0.12%. Look out below in the equity market if you get a big upside surprise on inflation later. Let's see if we get that. In the bond market, 2-year, 10-year, 30-year shaping up as follows. The 2-year still stubbornly around 5%, just won't go away. 5.03% on a 2-year, up a single basis point. And for all the talks of getting bullish bonds, BMO, call it a screaming buy.
Screaming buy.
Morgan Stanley, call it a buy. Wells Fargo, call it a buy. JP Morgan Asset Management, Bob Michaels sitting around this table yesterday, called it a buy. And here we are, through 4:30 again, Lisa, up 2 basis points, 4:30, 21.
I love this. I love that you framed it that way. For all the buyers out there, yields aren't budging. And so it raises a question, who's not buying and how much is this an international withdrawal? A Japan, for example, versus something more persistent that maybe has legs.
Sets us up for the Federal Reserve a week away. The week away for the Federal Reserve, for the ECB, a day away. And it's getting harder and harder as we inch closer to that decision. The euro looks like this. The euro against the dollar, 107.37, negative 0.16%. Late yesterday, a Reuters story. A Reuters story. Bear in mind there's meant to be a quiet period, but there never is. Because whenever they want to communicate, they can just leak whatever they want to leak to various media outlets, including this one. Cynical, it's real, it's reality, it's what's happening. Reuters come out and say that according to official close to the decision, we're going to get an upgrade to the inflation outlook for 2024, north of 3%, which reintroduces the risk that we get a rate hike tomorrow, Tom, from the ECB. And that risk is now on the table in a more profound way, more pronounced way, at the same time that we have reports that Germany is going to be downgrading their growth outlook to contraction for 2023. That's the mess that President Lagarde has to confront in 24 hours.
And the overlay with the drama of Mr. Putin meeting the gentleman from North Korea and all the imagery that we see of that meeting is completely unspoken as this war advances. Overnight, there were legitimate missile attacks on Crimea by Ukraine directly at the Russian Navy. And I'm sorry, that's an overlay to the strategy Lagarde has to impart on the herd of cats she has to herd.
It's been the story of the year, hasn't it?
Yeah.
The fragility of the energy backdrop.
I just don't think we talk about it. We do finance, but the fact is the war's going full bore.
Well, it's all connected, isn't it?
Yes, yes.
Without a doubt. Under surveillance this morning, the latest CPI reading from the United States is less than 1 hour away. Higher gas prices expected to help push month-over-month prices to 0.6%. Core is where the good news is for this Federal Reserve, at least 0.2%. Do we focus on core or do you focus on headline and what's happening in the commodity market?
I think it's a great question. Or do you focus on both? And when does headline start to matter more for the Fed when it comes to the potential for rate cuts next year? Can you see rate cuts with headline figures that are sticky on the heels of oil prices? I don't know the answer, and this is something that maybe we'll get a sense of today.
Need to get to this story. So earlier today, we heard from Spirit, which had to downgrade its outlook for revenue and had to do so because of higher fuel costs and ultimately maybe even lower prices. This from American Airlines just moments ago. This is the new range for EPS, 20 to 30 cents. The previous range, 85 to 95. That stock is down by 3.4%. That, Tom, is another downgrade from the airlines. And this market was in front of it. We've had a 20% move lower off the highs of July.
Right.
For the airlines on the S&P 500, off the back of higher costs, thank you energy, and maybe even lower ticket prices.
And what's so important to me here is capacity is actually up. There are fannies in the seat. John, I'm looking at a chart of American Airlines back to 2014. And let's be clear, this was a train wreck, no pun intended, before the pandemic. Since the pandemic, they've enjoyed going from 30 to 10. Maybe they rebounded a little bit, but they're rolling over now at a 13 level, back on their way potentially to break support and go down to pandemic worry levels at American Airlines.
Fuel prices up, Tom. They've also got to recognize, Lisa, in the third quarter, a $230 million retroactive pay expense as well. It's kind of all going in the wrong direction at the moment for these airlines. Labor unit costs up, jet fuel prices up, and maybe tickets not going up with it.
Well, they can't, and we've seen this because we do get some consumer pushback. That's what we're hearing anecdotally. And at first we said, yeah, right, prices aren't going down. And then anecdotally, when you start looking at prices to Paris, as Tom does every day, you start to get a sense maybe they are going down. The idea of this raises a question, is this just the airline industry? And they were one of the outliers in terms of the strength. If they're fading, is this really just a specific industry issue, or is this a broader question, especially with the UAW and the labor pushback, considering that that's really going to eat into their costs, into their profits?
So this conversation is coming at a perfect time for the inflation debate that we're going to have throughout this morning with CPI about an hour away, Tom. If you're looking at fuel right now, can you really pass this on? If costs are going up in corporate America, labor costs one, energy costs two, can they really pass that on to the consumer? Is that consumer price tolerance still out there in quite the same way? Arguably, relative to where we were 12 months ago, the answer to that is no. But how much has it changed, and how much weaker will it be going through year end?
Well, I don't think the airlines are a good example because, like I said, they're flat on their back near pandemic lows, unlike the Standard & Poor's 500, unlike the 7 glory stocks and everything else out there. But I think it's a sum of the parts. Why are used car analysis different from airline analysis? And the answer is used car prices, I believe, are maybe imploding is too strong a language, but they're disinflating.
Well, but it also points to the different economies and the different rolling recessions. Cars were what people bought in the pandemic. They couldn't travel. Then it was the revenge travel, and then they pulled back from some of the cars. My issue is, are we seeing the point at which margins have to compress more than people have previously thought? We see this with American Air. We saw that with Spirit. We've seen this across the airline industry. But it's not just there.
The back of this is disinflationary tendency. Perfectly timed. Megan Robson joins us, head of U.S. Credit Strategy, Senior Vice President, Disinflation at BNP Paribas. And what's so important here, we had on a guest earlier who frames out there somewhere next year a sub 3% inflation. What does your credit world do if we get airline disinflation, used car disinflation, aggregate disinflation, as some are suggesting?
Well, I think we're starting to see, Tom, signs of that with inflation coming down. I think a side effect that goes underappreciated is revenue slowing. And leisure has been a main top performer among high yield over this year, but we're starting to see early signs of weakness in some of those more cyclical sectors. So gaming is an example where we're seeing softer demand in some regions. I think airlines is another great example that could be impacted further by this risk of higher energy prices. But as revenue slows and you get some of these deflationary pressures, we expect margins to compress. And at the same time, you have a maturity wall that's approaching into next year.
Are the spreads at such tights, basically price to perfection types of level, if you just take a look at the extra yield over benchmark treasuries, are we really accounting for margin compression in corporate America in the credit sphere?
We don't think so. So we do see downside for credit spreads. We're forecasting wider spreads into year end. We think that decompression should play out. To really break out of this more narrow range, though, we do think we need to see more material weakness in the consumer. So we are watching for that as a catalyst, but risks are negative. I think in addition to all these dynamics, you have investor positioning, which has gotten much longer, and then this dynamic of rates being elevated in combination with margins.
High-grade companies coming to market, tons of supply. When does high yield come to play?
So high yield, we had a large investment grade calendar, very well absorbed, spreads unchanged on the week. I think what's interesting about investment grade is despite all the supply, you didn't see much on the long end of the Treasury curve. So decision makers are still reticent to really commit to issuing long-term capital. We have seen high yield supply start to come back to market this week, which is a good sign. Most of that has been on the refinancing side and higher quality. So we've yet to see sort of that expansionary type of supply from lower quality issuers, unsecured bonds.
If they came to market, could you give us an idea of the average coupon? What would it be, like 8%, 7, 8%?
So I think it depends by the rating, but we're looking at around 8.5% for the high yield market.
Can they live with that?
Well, I think that the lack of real pickup in high yield tells you that high yield issuers don't want to unless they have to. So I think there is, issuers can come to market and access borrowing so far if they need to. But over time, we're going to see that higher coupon, as it's digested, will eat into interest coverage even more than it already has. So we've seen interest coverage drop by about 1 times in the high yield market to about 4 times interest expense over our EBITDA over interest expense.
Are you managing for total return or to clip the coupon?
I think it depends on, it really depends on the investor mandate. So there is this debate.
My mandate is not to lose money like I have the last 3 years in bonds. Continue.
So I think heading into year end, we like carry. So we do think there's a narrow range for credit to trade in, and spreads will go a bit wider. But given how elevated yields are, carry is an attractive prospect for returns.
Do you ladder? Do you barbell? Do you single bullet? What are you doing here?
Well,
you need to make some money.
To my point earlier about investment grade supply, I think that there's a very positive technical on the long end. So we have lower issuance from investment grade issuers in the 10 to 30 year bucket. In our rate strategists, unlike some other calls across the street, we actually have constant, relatively steady 10 and 30 year treasuries heading into the end of the year. So we're calling for a 420, which we think could support long end performance.
The reason why some people say that the bulk of some of the rate increases haven't made it into the economy is because most companies haven't borrowed at these rates, particularly the lower rated ones. When does it start to bite in a more material way, where those that don't want to borrow, if rates are at this level and they have to borrow at 8-9% coupons, their business model does not work? When does that happen?
So we think it started to happen for floating rate issuers, and you have seen the leveraged loan default rate creep a little bit higher. Next year, we really think it starts to hit the fixed rate bond market in a gradual way. So for high yield, we forecast that about 13% of the market will have to refinance by the end of 2024. This will cause interest coverage to drop, and there's a lot of dispersion across sectors. So I think it really depends on the amount of lower quality issuance, a lower quality refinancing a sector is going to see, and that will really drive the impact to coverage. So some areas we see as more risky cyclical sectors, where places like tech and leisure, where you have not only the high maturity wall, but also this cyclical revenue exposure that we've talked about that could come down.
Megan Robson, thank you, of BNP Paribas. Some of the supply we've seen from high-grade companies in America, tons of it to kick off the month of September, one of the busiest starts ever to the month of September. Tom, whether that continues is a separate question. The real test for this market, I think, is when the high-yield stuff starts to come down the pipe.
What's Luca doing in Cupertino this morning?
Luca
It's like the show's over. How many gazillion can we raise now?
Usually when Luca comes out, it means one thing, Tom. Spreads are going wider. Yeah. That's usually the case with Luca's market timing. Fantastic market timer for whatever that's worth. Futures on the S&P 500, negative here by 0.08%. If you are just tuning in, welcome. CPI just around the corner. Equity futures down by 0.1%. Coming up, just after that CPI report, Tom Porcelli has a new seat. It's a PGIM fixed income. Very, very cool. His first interview with us right here on Bloomberg TV and radio, Tom, following that inflation report.
This is the single best guy I know on wage analysis in America. He was a wonder child on it. He was brilliant. This guy understands job market and wage dynamic like no one.
And cost pressures and inflation and all of that. We need to recap this American Airlines story. A cut from Spirit an hour ago, a cut to the outlook from American Airlines an hour later. It really does raise the question, I think, Bramo, for a lot of us this morning. Who's next? Who are we waiting for now? United, Delta, who's next?
This isn't just oil prices going higher. There is something more, especially when you start talking about the cost of employment and you start hearing about that kind of pushback. Does this lead or signal a wave of margin compression that is not yet priced in? This is something that we've heard a lot from Michael Wilson. Do we see this continue from other sectors in particular?
To me, it's hugely behavioral. They got to put fannies in the seat. It's a fixed cost experiment. And in the headlines, capacity is still there. They're hyper managing, as Robert Crandall invented, price discrimination within the cabin. And look at the Paris trip, 7,000 whatever, 14 grand, 2 people to Paris. It's now under 7 grand.
Total revenue per available seat mile. This is the range from American Airlines, Tom, negative 5.5% to negative 6.5. Previous range was negative 4.5 to negative 6.5. The outlook, not great. Coming up shortly, Republican Congressman French Hill of Arkansas on an impeachment inquiry in Washington, D.C. That's next. This is Bloomberg.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority. The markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
I am directing our House committee to open a formal impeachment inquiry into President Joe Biden. This logical next step will give our committees the full power to gather all the facts and answers for the American public. That's exactly what we want to know.
The latest in the nation's capital, Washington, D.C. That was House Speaker Kevin McCarthy. That conversation coming up shortly with Congressman French Hill, the Republican from Arkansas. Before we get there, just going into the inflation report in about 43 minutes' time in America. Inflation in America, the CPI report just around the corner. Equities look like this. We're down by 0.06% on the S&P, just a bit softer. Yields a touch higher by a couple of basis points, Tom, to 430.21.
430.21, and just a lot going on here. The countdown clock's helping me out today, John. 43 minutes, 4 seconds and counting here to the CPI report. It matters in New York. It matters in finance. You know what? It matters in Arkansas as well. I mean, it's that
big time.
Just that way worldwide. There's no other way to put it. Joining us right now, the gentleman from Arkansas, French Hill, Republican. French, I got like 14 ways to go, ending with Arkansas football. But forget about that. Kevin McCarthy has a football he's playing right now. I read Cass Sunstein's magisterial book, Impeachment, cover to cover. It seems like we're almost downgrading impeachment as a concept of our civics lesson. Have we ruined the phrase impeachment? Have we bastardized it?
Well, you bring up such a good point, Tom, and that's how I felt during the Nancy Pelosi impeachment for President Trump 1 and 2. I felt like it was rushed. I don't think people collected the evidence. I don't think they even looked for the facts during those years. And that's why I was pleased to see McCarthy this year really encourage Jim Jordan in the Judiciary Committee and Jamie Comer, who chairs the Oversight Committee, and the same for Ways and Means with Jason Smith. Do your homework. Don't rush this. And so for the last few months, they've asked simply basic questions about, Joe Biden says he didn't know anything about Hunter Biden's business dealing. He wasn't involved. He didn't have any business relationship. And what they've uncovered is that those assertions from President Biden weren't true. And so that's what's led, I think, Speaker McCarthy with Jordan and Comer to take the next step to give them an extra clout in asking the banking and legal records they need to answer those questions definitively.
Do you have any sense, as an adult in the room, Congressman, banker from Arkansas, do you have any sense that there are high crimes and misdemeanors involved?
Well, one of the constitutional lists of impeachment items in the Constitution, of course, is bribery. And actually in the whistleblower testimony from the IRS agents and other people that have come forward, there is that suggestion that potentially there was a bribe involved here or a cover-up of illegal activity when Vice President Biden was in office and Hunter Biden was taking action here. And then it leads to the question, well, what's happened since President Biden's been president? The only way to get to those facts is simply have both sides present those assertions and look for the evidence and follow it where it goes.
You know, I look, French, I know Lisa wants to jump in here. These are really important questions. Where is this going to be into the Republican primary season? I mean, I understand there's theater here. There are partitions of GOP. You're in a certain partition. Where does your type of Republican want this to be in February?
Well, I think for all Republicans, all Democrats, and all independents, to get to the bottom of this quickly and promptly is important, and see where the facts lay out. Perhaps President Biden and Hunter Biden, their attorneys, their lawyers, can present evidence that those suspicious activity reports, the LLC formations, the $21 million in payments to those LLCs, et cetera, all are completely logical and don't have anything to do with President Biden today or as vice president, and that'll clear up the whole matter. So I hope it's over just as soon as possible. But we want to make sure that the work gets done in an effective way, and that's what I really do contrast it with how the Trump investigations were carried on by the House Democrats.
Congressman, in your Bentonville, there probably is less concern about the impeachment proceedings and much more concern about the UAW strike discussions. What this means going forward for worker earnings, what this means for negotiating power. What do you hope happens tomorrow at 11:59?
Well, again, this administration has been very pro-union, and they have taken the side of the union in every legislative battle. So I think that question's better left for the administration. Obviously, the United States doesn't need a strike right now, but this administration has had such a pro-union policy in every way, stretch, and form. I'm sure the unions are feeling quite empowered to take action, and that's concerning to me because I think the economy is at a very fragile moment.
That said, I was looking at a number of reports calculating what the earnings of some of these union workers were, and extrapolating out to a 40-hour work week, it's about $35,000 to $67,000 a year. This at a time where inflation is continuing to rise and where we saw the biggest drop in household real income last year, going back a decade. What do you propose to actually increase wages at a time where, on a real basis, households are basically being taxed by inflation?
Well, first of all, stop inflation. And we could have done that if we'd taken our foot off the gas at the Federal Reserve in the fourth quarter of 2020 instead of doubling down and buying another $1 trillion of bonds and keeping interest rates zero. And if we hadn't unleashed an avalanche of spending to where we're now spending on an annualized basis over $6 trillion a year, when we were spending in FY19 $4.5 trillion. So beating inflation is the #1 way to help working families.
Well, but Congressman, I guess that, and I apologize for interrupting, I guess that I'm wondering what the cohesive plan is at this point, other than saying, you know, the Fed. What is the cohesive plan? Yes, spending cuts, although it's been on both sides of the aisle that you've seen spending expansion. What is the plan in the near term to bring down inflation from your side?
Well, I think they are linked, and you can't separate them. I mean, the Fed's job's been made much harder because of the incredible fiscal stimulus and regulatory burdens put on by the 2 years of the Biden administration. And that's why in the debt ceiling deal, we propose get more workers available for the workforce by encouraging work in the assistance programs, cut down regulatory burden, make it easier to get a project permitted, and cut spending and try to get spending back to pre-pandemic levels and stop having these huge budget deficits that Joe Biden has forecast.
Congressman Hill, a very serious question. We are so focused on 3 zip codes here, the doings of financial America and the global reach of Bloomberg and all. What are you hearing from small business people in Arkansas? The unemployment rate is low. Life is great. Arkansas is stealing for a game against LSU in 2 weeks. I get it, but what are you actually hearing from small business in your state?
Well, I spent a lot of time in August talking to businesses all over the 8 counties of central Arkansas, and I have to tell you that labor is still an issue for both white collar and manufacturing, where they're trying to find the right people for the right seats with the right training. And so Governor Sanders has really put an emphasis on workforce development. That's something I've worked on for the past 15 years as a bank president, as a chamber chairman, and now as a congressman. And so the technical skill attainment, and then just the bodies, Tom, it continues to be an issue. We have low unemployment in Arkansas, and despite inflation, and despite all the economic challenges, that's what I hear about both with community bankers and with individual business owners when I'm at home.
Razorbacks at Tiger Stadium, TK.
They're going to get past BYU.
Are you proud of me, French, that I know all this now?
Yeah, it's just great.
I see engagement. We're taking a baby step forward, and the next step is to visit Razorback Stadium in Fayetteville.
That's up to you. We're going to make it happen. Congressman, thank you. Congressman French Hill there on the latest, an impeachment inquiry and the cost of living, Tom, in America.
Well, it is. In the inflation report, we were 34 minutes away from this key inflation report. And to me, John, the heart of the matter is the fancy people we talk to, like Rabila Farouk, have disinflationary tendencies in place. Our world changes with sub 3% inflation, except in Arkansas, that's not how they feel.
I've been surprised that presidential candidates have been going after Chairman Powell. I'm not sure how that polls. This is what you should do, exactly what French Hill just did. The reason why rates are high is because they've been doing XYZ in the White House. That's a more effective line of attack, I think. I mean, how many people in this country know Chairman Powell is and the Federal Reserve?
Are you busting my chops because I didn't know what Generation XYZ was yesterday?
Yeah, I am. Yeah. That's exactly what this is about. That's exactly what this is about.
You're brutal.
Daryl Cronk of Wells Fargo up
What's
next.
the connection?
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a 6-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further.
Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The effect of the massive policy tightening that we've had is going to have an effect on the economy. It's just taking longer to percolate than people thought.
I think the Fed absolutely has more ammunition in its tool belt to continue to raise rates closer to that 6% target.
They were already wrong once on inflation with the promise of transitory. They can't be wrong again.
The Fed's getting its way here. It's removing some of the demand, some of that froth, and yet not crushing the economy.
It's more likely that they hold rates here or maybe one more rate hike as opposed to go ever higher.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. The countdown clock says it all. 29, 10, 9, 7. The gantry separates here.
You're going to keep this up.
The inflation report
Lift
in
up.
30 minutes. And what we've got is the airlines maybe telling Washington authorities what's really going on.
They're telling you two stories. Labor unit prices are higher, jet fuel costs are higher, and ultimately, here's the question. Can they pass it on to the consumer? That's what we'll be talking about in about 29 minutes' time when that US CPI report drops.
All sorts of ways to go here with this inflation report. Rabila Farouki, I think, with the comment of the day, looking for a modeled out sub 3% inflation out there somewhere in 2024. And the key thing, John, is how does it fold into what we do with markets? What does it do to the Saudis and oil? What does it do to the stock market?
Crude, 92. That's the number that matters right now, Tom.
Yeah.
89 on WTI. On Brent crude, 92.53. Headline inflation's going to be elevated because of gas prices. I think we all know that. It's baked into what we're estimating, actually. Headline to come in at 0.6% month on month. It's core. Where does core land? 0.2 is the expectation, which is why, in the minds of so many, Tom, rate hikes are on ice to the Federal Reserve next week. But there is this risk This risk is still out there that maybe inflation starts to pick up again. And that's why this Federal Reserve needs to be somewhat cautious, TK, about how things materialize into year end and beyond.
It's out there. There's a toxic brew out there 28 minutes away. But Lisa, the real question is, what do we do at 8:31? How do we readjust to what do we got? Line up the ducks, a UAW strike, Formula One in Singapore. Then we move on to a Fed meeting. We're going to London on a reduced fare. Did you see that?
I did see that.
Yeah.
Did you get a reduced fare?
I got a reduced fare. They said
I booked my ticket months ago.
Redo Keeper of the Amex said, Tom, you're not taking the Gulfstream. Move on. And so there we are. Lisa, what do you think of this? I mean, at 8:31, we recalibrate.
It's actually a really good question, which is what is going to move the needle, given the fact that everyone is looking at core, expecting it to be sort of in line and not really showing any reacceleration. Headline numbers, people are expecting to go up, and they don't really care. They're saying, it's transitory. The Fed's going to look past it. When does that headline figure really matter in a more meaningful way? Can the Fed be cutting rates next year if the headline figure is still running really north of 3%, north of 4%, even on the heels of oil prices?
Torsten Slok channeling Jason Furman up at Harvard. I've been talking this up, John, whether it's 3-month moving average or 3-month annualized. Slok publishes today the trend, the vector in non-farm payrolls. 700,000. He's out about the time of the Arsenal-Tottenham derby that we see next year. 20,000 positive. Wow. David Kelly at J.P. Morgan says a negative NFP. That begins to fold into the debate after 26 minutes away.
Thanks for the promo, because Torsten Slok's joining us, I think, in about 57 minutes' time on the Open on Bloomberg TV. So
That'll
we'll have
be
this
good.
conversation.
Well timed.
He put out some great charts over the
He's gonna
weekend.
wear a Jets jacket?
I've talked about that over a couple of days. That's Mohammed on Friday. He'll wear a Jets jacket.
Okay, excuse me.
He's put out some great charts over the weekend, TK, about why he thinks maybe we are sufficiently restrictive away from the mortgage market, what you're seeing elsewhere. Delinquencies up, bank lending started to contract in various places, and that'll be a part of the conversation we have with him a little bit later.
Speed data check, 10-year real yield, 1.96%.
How fast? Just super quick? Equity futures down.
We got a great guess.
By 0.03%, yields up 2 basis points. Tom, your yield 4.30.
25 minutes, 37 seconds away. Daryl Cronk, Chief Investment Officer, Wells Fargo, joins us now with decades of experiment. Everybody's in a lather. Do I buy stocks? Do I add to my portfolio now? Do I go to cash? What's the mood at the margin with equity allocation?
At the margin, people are basically renting the market right now with a VIX that's at 14. You can use the options market with cheap premiums to get your exposure, but they're quick to sit near the exits. It's like your airline ticket to Europe. You want to buy the best seat and sit near the exit, right? And be ready to basically get out. So I think it's, we're stuck between this 4,300 and 4,600. All we've done is bounce back and forth between it. At this point, you need something to change in the baseline to really accelerate beyond the 4,600. Equity risk premiums are at a 19-year low. I'm not getting paid to take equity risk today.
Can we build on that just a little bit? Because I was curious too. I was looking back to the last inflation report. I think it was August 10th. Since then, the market's just been dead flat.
That's right.
And we've got the data we wanted to see, didn't we? With further signs of disinflation, growth still robust. What aren't we happy with?
So let's talk about inflation for a minute, right? What nobody's talking about this morning, everybody talks about the headline number, obviously going up because of energy prices. Everybody talks about core coming down, right? Which is important. Double click on core, right? Double click on core. What is Powell's super core doing ex shelter? It's going to go up 0.4 this month from up 0.2 last month, right? And it's still going to be running north of a 4% number and maybe even a 5% number. So if you think about, if you bookend this with headline, super core with core in the middle. Yes, core in the middle is a good story. Headline's not a terribly good story with the oil prices where they are. Super core is not a good story.
So what are we talking about here? What industries are sort of reaccelerating in a way that's catching the Fed's attention? Because I'm getting lost in the core, super core, non-core, how core. At a certain point, what is the Fed really keying in on if you are seeing housing costs disinflating on the margins? And, people are seeing goods prices disinflate at a pretty hefty pace.
Yeah, it's a good question, Lisa. So I would say, obviously, if you think about inflation, it's commodity prices, it's wages, and it's housing. Out of those three, housing is giving us some good data, right, in the form of slowing, right? You're seeing mortgage apps go down. You're seeing existing home sales come crashing down, actually. Rents are coming down, so that's good. Commodity prices and wages are still very, very sticky. So if you get into that supercore, why is it up 0.4 to your point? travel, the travel is starting to fade now, basically, and health insurance numbers are fading. So the services piece, which is what Powell cares about, is still running much hotter than people expect and want. So I think you've got to really look into the data much deeper than what a lot of people are doing. They want to take the core and run with it. It's a little bit like, I'm going to use a John analogy here, right? It's Goldilocks and the Three Bears, right? It's the English fairy tale, right? Everybody wants Goldilocks to the equity markets, but your three bears are oil prices, interest rates, sitting a few basis points off a cycle high, and earnings, right? Which we're coming to the end of third quarter. Earnings growth is still going to be basically zero for third quarter, which is still going to be a challenge. So who's going to win that battle, Goldilocks or the Three Bears?
Given the fact that basically you're saying oil prices matter, and they're going to matter to the Fed, and they're going to matter to input prices for services that really count on oil. So what are you expecting? How high does the headline figure have to be to capture the market's attention to mean that the Fed has to respond to a headline figure that a lot of people say is very volatile?
I think the upside is calibrated well there. I don't think a headline number can get them off center for September. It may put November back into the conversation, right? But I think if you saw 8/10, 9/10 on the headline number, right, which would take your headline basically from, it'd put it somewhere around 4.7, 4.8, pushing a 5 number again. That would certainly get their attention, but they'd be able to, again, calibrate it to energy prices, you know, and food prices have moderated some, right? But, you know, I don't think the headline moves it for them. I really think the story is about core and super core, ex-shelter.
Do you think they're still willing to beat down growth to get inflation lower?
Yes, absolutely.
I didn't get that impression in Jackson Hole whatsoever from the people around that meeting.
Well, look at, so in June, 12 of the 18 members who have a vote on a dot, right, an SEP, right, still say there are more hikes ahead of them. That didn't change in July, right? We'll see if it changes here in September. So they're still saying, like, look, we've got at least one more hike. Now, again, the market's taken solace from that of, like, that's the end of the road, right? It's kind of like one more for the road, right? One more hike and then we're done. And so they're taking solace in that, but it's what everybody talks about. It's keeping rates high for long and the grind that happens on growth.
I want you to talk to retail, institutional, Wells Fargo clients who have hit a home run with these 7 big tech stocks. They're all trading at 30 times multiple. So if I take a 30 times forward multiple Microsoft, how does that react given a presumed growth scarcity? Do they become ever more treasured and even sustain or trade higher in PE?
Well, that's been obviously the trade this year, which is when growth is scarce, right? You take whatever growth you can get, right? Which is the place you've been getting growth. I think what's interesting is if you break down things like the semiconductor industry, which is the darling, right? You've got now half of that industry in the S&P 500 below its 200-day moving average, right? It's failing technically right now. Consumer discretionary, half the names in the S&P 500 below their 200-day moving average, right? So under the surface, again, you're starting to see erosion and deterioration.
Are you seeing that in Apple, Microsoft, and the others?
Yes. They're all sitting, I mean, on a technical basis, the 20-day pierced the 50-day from above, which is a bad technical sign, and you're starting to see them fall down below the 50-day, which there's a big blue sky between the 50 and the 200-day, right? So what I would say there, Tom, is you're losing engines, right? If those were the engines for the first half of the year, right, think almost in terms of a plane, you're losing those engines that you need to really drive us forward here. And I agree with the conversation that you had yesterday about the consumer is stretched here, right? We have to pay attention to that.
Can we put some numbers on this just quickly? What kind of downside are you thinking about?
So we think the risk reward for equities, right, if you just use the S&P as a proxy, starts to turn around 4,200 or less. So it's probably, you know, I'd much rather see it around 4,000, 4,100 to get equity risk premiums where they are, get multiples where they are. I mean, today, if you just simply take a 20 multiple,
you sounded super gloomy, so it's not that drastic. It's 300 points.
No, I don't think it's a correction, right? Yeah. And I think you use that correction to base off of for next year. But at 20 times earnings, right? You not only need earnings growth, the market's starting to demand it, right? It has to have it, right, in the back half of this year and early next year. So we've got to turn that at some point.
Daryl, this was thoughtful. It's good to see you. Always
you
is.
too, John.
Daryl Cronk of Wells Fargo. If you are just joining the program, welcome. We're counting you down to CPI in America. Equity futures right now on the S&P, totally unchanged almost. We're positive by 0.0. 1%. Coming up shortly, Tom Porcelli of PGIM Fixed Income to weigh in on that inflation data. Mike McKee's going to be with us around the table as well, as is Regina Mayer of KPMG, because on CPI Wednesday, TK, we have got to talk about the price of a barrel of oil, WTI and Brent, at new highs for 2023.
Regina Mayer brings a great scholarship to this, and next week in London, I believe we're scheduled to meet with Christian Malik, who's just brilliant on EM demand and such. And you know, I made as a joke earlier the stew that's out there, but you look at the airline shortfall, what it's done to that sector, if you will, back to pandemic, literally back to pandemic lows. And the basic idea I would have is, are we going to get clarity here in 17 minutes, 15 seconds? And I'm going to say, yes, we are going to have a clearer picture here at 8:31.
On what do you think specifically?
The vectors, the 3-month. Yeah, I'm going to 3-month annualized. I was trained to take 90 days of data and squeeze it out 1 year as a respectful guesstimate. And that's a raging debate among the nerds right now.
Where's the clock now, Lisa? 16 minutes and 51 seconds, something like that?
Yeah, you know, I actually agree. I think that we will get a lot of clarity, but not because of the actual numbers, but because of how the market responds. I think it'll be interesting to see where the balance of risks are right now, not for the Fed, for the markets in terms of upside or downside potential surprise.
The 2-year yield came in a 5.04. I don't think that's a small matter.
I don't disagree. Yeah. It's near cycle highs.
Yeah.
Going into an inflation print that is set to show further signs of disinflation on core. That inflation report is about 16 minutes away, 18, live from New York City,
17,
with your equity market 15, totally unchanged 14, on the S&P 500.
15,
this is Bloomberg.
Gantry's pulled away.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. JetBlue has traveled a long way from its startup days, but CFO Ursula Hurley says growth won't change the airline's quirky attitude.
At the end of the day, we view ourselves as a disruptor and a maverick in the aviation industry, and I'm really excited to play a meaningful role in that growth journey.
Watch Chief Future Officer today on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Will the ECB hike or pause this week?
There's a lot in flux at the moment.
ECB, they're stepping harder and harder on the brakes.
You have to be cautious.
It's much too early to think about a pause.
Inflation expectations remain anchored at 2%.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
Is there a real danger of over-tightening at this point?
Stopping too early is a bigger problem.
Coverage begins Thursday on Bloomberg. Context changes everything.
More likely that they hold rates here or maybe one more rate hike as opposed to go ever higher. I think where the market may be a little bit off base is to think that the Fed's going to ease a lot in 2024. I think the last mile in terms of getting inflation down, I think is going to turn out to be pretty difficult. And so I think that means that the Fed's going to keep rates higher for longer than people think.
Bill Dudley just nailed this Fed rate call a couple of years ago, the Bloomberg opinion columnist and former New York Fed president. I remember the conference. I was speaking to him, Mohamed Al-Aaron. It was the summer of 2021, and Bill was talking about Fed funds going through 5%.
Yeah.
And at the time, Tom, I think we're all just shaking our head. What's Bill Dudley talking about? 5%, and here we are staring down a prospect to getting closer to 6. Never mind going through 5.
How did he do this? It was Dudley and McKelvey at Goldman Sachs. They had a young Turk, I think he was 23 years old, named Hatzius, who, picked up the coffee and be sure everybody was
He's doing all right at Goldman now, yeah.
And in the crucible of market economics, he would crank this out. He is a lone duck in our monetary policy. He's been in the crucible, again, is the right word. He's been in the market economics of day to day. Very rare.
And he's now talking about higher for maybe even longer. Let's go through the price action together, just going into this inflation report about 13 minutes away. Equities are totally unchanged on the S&P 500. In the bond market, yields are a little bit higher by 3 basis points at 431. The dollar's stronger against the weaker euro at 107.31 into the ECB tomorrow. But here's the number I want to talk about. 89.20 on WTI. On Brent, 92.46. And for the airlines, it's getting tougher and tougher. Unit labor costs are up, fuel costs are up, and the outlook is not looking good. We get a cut to the outlook from American Airlines this morning, Spirit as well. Lease American down 3.26%, Spirit off by 4%.
And you could see the declines in commensurate airlines across the board. What's interesting to me is it's not just Spirit, which is more domestically focused. It's also American. This is a broad-based weakening when it comes to profits and the compression that you're seeing with costs going up, which raises a question, and we were talking about it earlier.
Oh, we're on the same page, Bramo.
Very
totally.
much. Is it just an airline story, or is this a broader economic story of what's to come in corporate America?
Can they pass it on?
Yeah.
Can they pass it on? So let's take crude. I'll go back to that framing we used in the last couple of hours. Is oil an example, a reflection of the extension of this cycle? Things are better than we thought they were, and we can absorb prices like that, or a recipe to end this cycle? I'm not just going to talk about crude. Lisa, let's throw in yields as well. A high yield's a reflection of the extension of the cycle, or a recipe to end it?
6 months ago, everyone said a recipe to end it. And then they were wrong.
Here we are.
And the economy just kept grinding along. Yes, we can exist at 5% benchmark rates. So if that's the case, are we misunderstanding some of the oil prices that everyone is saying is purely from supply cuts by Saudi Arabia? Is it also a demand side that could keep it going for longer than many people would like?
Can this economy get by with $92 Brent and 5% interest rates? We'll see. Inflation data just around the corner. Allow me to share the estimates with you. Month on month for headline, 0.6%. The previous month, 0.2, 0.6 is the estimate in our survey. Month on month for core, better reading. 0.2% previously, 0.2% in our survey. Mike McKee, you've got to break this one down for us in about 10 minutes' time. Mike, what are you looking for?
Well, we're looking at some of the categories that you just have been talking about. You and Lisa, airline fares have been down for 4 months in a row. They dropped 8.1% last month. Now, can that continue? That's something to keep an eye on. Maybe in August it did, but going forward with fuel prices up and now they got to pay these huge wage settlements, airfares could be going up again, and that's a fairly heavily weighted category in the core. We're also looking at shelter costs. Do we still see progress on rents and owner's equivalent rent coming down? And of course, everybody's favorite, used cars. Here's a tipping point. Is it going to change because the UAW goes on strike? The big three have very large inventories right now, so it won't matter for a while. But if it were a long strike, then you'd probably see used car prices go up again.
Mike, just to build on the oil conversation and this question of headline CPI versus core, at what point, based on your knowledge of the Fed and its history, what point does the Fed feel compelled to raise rates in the face of higher oil prices?
They probably don't, in that sense that they wouldn't directly attribute it to higher oil prices because the Fed can raise rates all at once and it won't push oil prices down. What they'd be watching is consumer expectations. Do inflation expectations start to rise because people are paying more for gasoline? And that would have an impact on them. But exactly how do you attack that is difficult when it comes to oil.
Mike, 8 minutes away here. First thing I did when I walked in the door this morning morning is went to my favorite Cleveland 16% number. Great series out of the Cleveland Fed. Which series away from this gives you a better core knowledge than core?
Better core knowledge than core. I mean, the Cleveland Fed is good. You can also look at the Dallas Fed has a trimmed mean as well, and a lot of Fed officials like the Dallas numbers. And also, what's kind of interesting is it only gives us a sort of look backwards, but the consensus forecast of economists surveyed by Bloomberg is one of the most accurate of anything that we survey on. So if we come in at 02 today and we come in at 06 on the headline, that'll just show you pay attention to the people who have Bloombergs.
Mike McKee will continue with us here 7 minutes away from this important report. We're going to digress here. As John mentioned, what else matters? $92.45 Brent crude. Regina Mayer is Global Head of Clients Markets and Petroleum at KPMG with military service to the nation. Regina, thank you so much for joining us today. Your research note is demand, demand, demand. Are the Saudis aware of the resiliency and demand that KPMG projects?
Absolutely. So part of the supply challenge is it's against the backdrop of a stubbornly robust economy, but it is also a big supply part of the equation, right? We are anticipating supply drawdowns through the rest of the calendar year, Q3, Q4. And we're in probably the tightest supply situation than we've been in 10 years, 10-month crude highs that you've emphasized. But what I'm looking at are some underlying indicators. U.S. production is almost at its record high, 12.84 million barrels per day against a record high of 13 million barrels per day, with 17% of the rigs off the market. That's 127 fewer rigs, with the Saudis intentionally keeping barrels off the market. Right now, we're saying there's roughly a 3 million barrel per day supply versus demand gap because demand continues to go up. And we think OPEC's purposely keeping about 1.8 million barrels per day off the market. And there's no global relief valve in this environment. We can't rely on the SPR. There's no other source where we can turn on a tap and oil will flood back into the market.
Given the fact that production is so high in the United States, is that an indication that, yes, inventories are the tightest, as you said, going back 10 years, but this isn't as much about supply as it is ongoing continued demand, and that people are underestimating the strength on the other side that's also fueling some of these price increases?
Yeah, so we've been talking about peak demand. Potentially it happened pre-COVID. I think we definitely have put that in the rearview mirror. Right now, the EIA is saying average demand for 2023 is going to be over 101 million barrels per day. That's average. So last month, we just came off one of the hottest summers in a lot of years, and we're anticipating that's 103 million barrels per day. That's the 3 million barrel per day gap. And then the EIA is projecting it goes up to 102 million barrels per day in 2024. When is peak demand going to take place? Some are predicting it's this decade. Some are predicting it's next decade. Regardless of which decade you anticipate that it's coming, we know it's coming. So if you're a major oil company or a major resource holder, you're trying to figure out when's the last marginal dollar of additional investment that I'm going to put in to grow supply against a backdrop of ultimately that supply is going to be in excess of demand.
Given that backdrop, if there is a recession or some sort of downturn, a softening in the economy, could that offset the tightness in the oil market? In other words, could oil prices come down sharply in a surprise, even with all of these technical backdrops, simply because you do get a weakening of the consumer?
Absolutely. I think if we start to see more signs that the economy is slowing down, you will start to see oil prices come back down. We are seeing the potential for supply rebuild in 2024. So it's really just this 6-month period. I know there are some that'll say it's triple digit for longer that's coming. I think there are bear signs in the market. But right now, frankly, it's all upside, very little downside.
Regina, just one final question here. With great respect for your bringing in international relations into the KPMG oil debate, does the United States of America have an energy policy?
I think we have different aspects of energy policies. I think some of the things that we've just recently seen on Anwar is more politics versus substance. It would have taken billions of dollars in investment to get drilling production and then moving that material to market. we would be best served to focus on where are our great sources of resources, Gulf of Mexico, onshore and conventionals, other dry gas plays. There are lots of different factors that slow down the ability for our industry to exploit those resources. I do think there's room for a more coherent, more effective energy policy overall.
The policy is lower prices, TK. I think that's the policy. We just want lower prices. That's kind of it.
That dead on.
Regina, just quickly, when does demand destruction start to kick in? Aren't we already thinking about that in the 90s?
For sure. I mean, I think if gas prices go substantially over $4, we're at the end of summer driving season, and U.S. gas prices are 12 cents per gallon on average higher than they were this time last year. That's probably not enough to drive demand destruction, but some of the things that you are all talking about relative to airfares, the pinch that people are starting to feel relative to how confident they feel about the future, how confident they feel about their savings cushions. I do see some of those pressures that could dampen demand as we move into the fall and the winter.
Regina Mayer of KPMG on the oil market. Regina, thank you. Crude, Brent through the 90s, WTI getting closer. The inflation report about 2 minutes away. Given what we're discussing here, what's more important, inflation in a couple of minutes or retail sales tomorrow? Drew Madison, MetLife, writing in, inflation trends is unlikely to move in a way to prompt a change in Fed thinking. Retail sales more likely to change Fed
totally agree.
Thinking. That number drops, Tom, tomorrow morning.
I have it right down in front of me. I brought it up just as Drew was probably right in that. The idea, I agree, retail sales dovetails in here with a GDP adjustment, given any shocks, and then that goes into where Torsten Slok is in your 9 o'clock hour, which is a non-farm payrolls coming down.
Lisa, that speaks to the question you've been asking all morning.
Yeah, well, this to me is, at what point is retail sales a reflection of whether higher inflation is essentially eating into discretionary spending? And that's, to me, the issue right now that we're facing off with, and that's the real question. And retail sales is the kicker to the chaser, which is really what we're going to get today. And ultimately, we just don't know, because it might have been boosted. We saw that, some of the peripheral data, there was, Amazon Prime or whatever, and people are back to school. And when you strip out all those distortions, what do you get? It's always been stronger.
You said something earlier on this week that I think is really important, and I saw it in Citi Research as well, so they agree with you. When the data starts to contradict, we're at turning points. And Citi said the same thing, Bramo, and there's a lot of data out there at the moment that seems to be contradicting with each other. Claims are super low, and then you look beneath the surface of the jobs market, you start to see some cracks emerging.
I was speaking with a policymaker, and I was saying to them, is the data manipulated? Is it fake? Is it the idea?
Massaged.
Yeah, is it massaged?
Is the word,
is it this people aren't really responding to all of the surveys? Is it messy? Is it inaccurate? And they just looked at me and they said, this always happens at these moments.
Yep.
We just don't know which way it's going to turn. It is too facile to simply shrug it off as wrong.
Inflation data 15 seconds away, going into it. Equity futures on the S&P just slightly lower on the S&P 500. Yields in the bond market on a 10-year up by a couple of basis points. On a 2-year, 5.03%. Yields higher there by a single basis point. With the economic data this morning, here's Mike McKee. Morning, Mike.
Well, I said that economists were pretty good at forecasting, and they were pretty good at forecasting this time, except for the core there. It comes in a little hotter at 0.3 on the month, which pushes the year-over-year core to 4.3, still what had been forecast. The headline is up 0.6%, and that is what was forecast. And so the year-over-year number rises to 3.7% from 3.2. That's a tick higher, so it looks like perhaps that 0.3 was a revised up number. Let's take a look at some of the categories here. Food prices up only 0.2, so no real change there, but we get a big jump in energy prices. Gasoline up 10.5%. No surprise, I don't think, to anybody, but it definitely has a weight on this index. Used cars and trucks fall again 1.2%. They're down 6.6% for the year, so that puts pressure on the other direction. And then, of course, services, less energy services up 0.4, but that includes a 0.3 gain in shelter. So let's see what the markets are doing. I'll get you some more numbers here in just a second.
I'll start with the bond market, Mike. Stay close. I'll come back to you in just a couple of seconds. So that small upside surprise on core inflation lights a fuse under the dollar. The dollar is a whole lot stronger off the back of this. Yields are a whole lot higher in the bond market, up 5 basis points on a 2-year. 5.07%, call it 5.08 on a 10-year yield higher by 6 basis points. So the whole curve a lift here. Yields pushing higher right across the curve. 2s out to 30s. Got a 10-year higher by 6 basis points at 434. 30 are up by 4 basis points to 439. But it's that 2-year piece of the curve that gets your attention. So yields up. Dollar stronger, euro dollar holding on to 107 again at 107.18, and equities just a little bit softer here. We're lower by about 1/4% on the S&P 500. Mike, you've had time to take a second look. What stands out for you now?
Well, we were talking about airfares before the numbers came out, and airfares did rise 4.9% during the month. So that is important. Now, breaking down the housing numbers, we see shelter, as I mentioned, had been up 0.3%. Owner's equivalent rent up 0.4%, but rent of a primary residence up 0.5. That's a rise from the prior month of a 0.4 gain. So it does suggest that there is an issue with housing still not coming down the way that the Fed would like to see it. Overall, this is probably neutral for the Fed, and we can talk about the idea that perhaps we see retail sales have more of an impact, but hard to say at this point that anything will derail them from September hold.
I've got a derail, Mike. I got yen out to near 148. That gets my attention. It's a global distraction, but I've got a 10-year real yield out 3 basis points, popping a 1.96 right now. We even saw 1.98 seconds ago. Does an elevated real yield figure into Fed calculus?
It does over a longer period of time. As inflation comes down, obviously, real yields are going to rise. So the Fed has to keep an eye on that. They don't want to get any tighter than they feel they must be. But that's a long way away, and inflation on a headline basis for the CPI went up. Remember, the PCE is the Fed's indicator, and that has been moving at a slower pace than CPI. So the Fed is not overly concerned about where we are with real rates yet.
What I find interesting, Mike, just in the price action of the markets, is that the long end is also affected in tandem with the short end. It's sort of this feeling that this robustness of the U.S. economy can continue even with rates where they are, even despite all of the negative discussions. From your vantage point, is it surprising? How surprising is it that we got some of these upside surprises in the core element, which was exactly where everyone was expecting to see the softness that everyone was hoping for?
Well, it is obviously a bit surprising. On a year-over-year basis, base effects mean that we don't lose any ground. We see the core year-over-year come down some. But the services prices, and we have to dig into that even further, the services prices are going to be a concern for the Fed. Now, one of the things that we had seen in the past is that commissions on Wall Street had gone into the CPI and the PCE and pushed up that services X housing number. And I haven't gotten that far into the data yet, but that's something to look for as well.
Mike, we'll come back to you a little bit later. Looking forward to catching up. Let's run through it. The fun and games lasted about 60 seconds. The whole move has faded since then. Equity futures basically back to where they were on the S&P 500, negative by 0.1%. In the bond market, we look a little something like this. Treasuries, 2-year, 10-year, 30-year. Yields higher, but that move fades as well, up by 2 basis points on a 2-year to 5.04%. And if you take a look at the chart of the euro, if you can access one, basically back to where we started. We're negative 0.2%. Dollar's still stronger, 107.32. To discuss a little bit later in the next hour, Torsten Slok of Apollo, Caterina Simonetti of Morgan Stanley, Robert Tipp of PGIM TK, all of that in the next hour on Bloomberg TV.
So nothing burger, and what does it mean for retail sales tomorrow?
Basically
it's
that.
Simple.
That's it. 60 minutes of that,
Are you
Tom,
okay there?
on Bloomberg TV. That's the tease.
We're going to continue right now. And speaking of Mr. Tipp at PGIM, joining us right now is Thomas Purcelli, Chief U.S. Economist at PGIM Fixed Income. He's definitive with work on the open market desk at the Fed, and also truly great work on wage dynamics in America. Congratulations on a new shingle across the Hudson.
Thank you, sir.
As simple as I can, I want to go to your wheelhouse right away. You're talking to Greg Peters, which is really difficult. You've got to, prepare, medicate yourself.
He's the best. Love him to pieces.
You're talking to Greg Peters here, and he's going to turn to you just like I am and say, okay, but what about wage dynamics? That's what you on the high ground on. How are wages in America into 2024?
Yeah, look, I think here's the problem for the backdrop with regard to wages, which, look, in real terms, I think we'll appreciate are sort of performing decently. The challenge, though, is if you have real revenue that's moving sideways, right, which it is, and you have, which obviously is a function of the consumer that is sort of slowing down to some extent. How do companies respond to that? How do companies respond to real revenue moving sideways, wage pressures firming up a bit in real terms? I think that, to me, that's a perfect recipe for companies to go after labor, particularly if it means you're going to get a margin compression, which is something that we've been talking about for a while, and I think, Lisa, you and I talked about that last time I was on. That, to me, is a challenge as it relates to sort of the labor dynamic in the United States.
To translate this,
yeah,
they're going to be layoffs. That's basically what you're saying, is that if you see this incredible margin compression, if you see costs going up, and you see consumers pushing back on prices, the next step is people are going to lose their jobs. How much pushback is there actually to pricing if we're still seeing robust services side inflation, as this report just suggested?
Yeah, so, and what we know is that wage pressures, again, remaining firm in real terms, but it's coming in the context of inflationary pressure that's now slowing down. I mean, this 2/10 that we got, I get it, firmer than expectations, but that still doesn't change the trend. The trend of inflation is actually moving slower. So that means that the pass-through is becoming much more difficult for companies.
Well, but we're seeing this, we saw this with American Airlines and Spirit earlier this morning, so the pass-through is getting more difficult.
And, sorry, no, I was just going to say, Lisa, I think it's such an important idea. Not only do you have that idea, this dynamic where the pass-through is becoming much more complicated, but, just look at what some of the retailers have been talking about. I mean, the consumer is now trading down. Right? I mean, just in the context of these wage pressure, these inflationary pressures that are out there, I think it's such an important idea.
The problem with it is, and this is what I'm struggling with, and I think a lot of other people are as well, we were saying this 6 months ago. We were saying that consumers were going to push back and that savings were going to be beaten down. And suddenly, we were going to see, a recession. It didn't happen. And the data just keeps surprising to the upside with this yet another surprise to the upside in core. How can you explain that?
Yeah, so I think there's a really easy way to explain it. So, in fact, there's a couple of ways to explain it. So one, the idea of excess saving is real, right? I mean, and the consumer's still working that down. So let's just be clear. The consumer has had a massive pool with which to sort of dive into. Excess savings was one of those ideas. The other was credit. I mean, credit usage has been, sort of off the charts. I mean, you're looking at revolving debt that's now running at $1 trillion. And so the consumer has been able to sort of perpetuate the sort of the consumer backdrop as a result of these two ideas. But just to be clear, that now is sort of drying up a little bit, right? Excess saving continues to fade. It's not gone. It continues to fade. Banks are now actually getting pretty stingy as it relates to how much credit they're willing to sort of lend out. And we can see that in, obviously, banks' willingness to make these kind of loans. And so I think the whole, this backdrop is drying up, right? The ammunition is drying up for the consumer to some extent.
What I think is so important here is, and with Robert Tipp coming on in the next hour with John, you've got to turn to a bunch of bond animals with the ambiguities between your economics and their portfolio management. Can you assume a disinflationary tendency means price up, yield down in bond portfolios? Is that just a given?
Yeah, so I think this is a really important idea. One of the things that we've been talking about at PGIM is this idea that rates can stay high, rates can stay pretty elevated. And I think that you can have rates remain pretty elevated. I mean, when I think about sort of the Fed's reaction function to all of this, and again, I get it. On CPI day, we're talking about inflation. But the thing that I keep on coming back to, and I'm trying to bring it back to this today, here now, is the labor backdrop. Because I think when push comes to shove, I think the Fed's going to be very responsive to the labor backdrop. So I can easily make the case for the Fed to engage in an easing cycle. Now, I think when people say easing cycle, I think they immediately think of, hey, this big aggressive easing cycle. It's not going to be that. I think it's a dynamic where the Fed cuts back.
Their easiest path within asymmetry is to go longer. To stay elevated and go longer. I agree.
100%. And so to me, that's sort of the big challenge here for the Fed. I think it doesn't have to be a big aggressive easing cycle. It's not going to be a big aggressive slowing in economic activity.
Come in 25 or 50 beeps and just sit on it through 24.
I think that's exactly right. So our call has been, you can easily see a dynamic where the Fed cuts, call it 50 to 75 basis points over the coming year. And I think that's how you sort of get to this dynamic where rates still remain pretty elevated.
Which is the reason why why I wonder if Goldilocks and a soft landing is the best case scenario for risk assets, or if it's actually the worst case scenario for risk assets over the longer term, particularly corporate credit, when you face off with this idea of refinancing. What's your view? Is that potentially problematic?
So it can be, right? I mean, I think the rollover risk idea will become a challenge, but that's not a challenge for necessarily right now, right? I mean, a lot of companies have done a great job of terming out their debt. One of the things that we've been talking about at PGIM and Dilip, my boss, I think he's been absolutely fantastic about highlighting this really important structural idea that's out there. I mean, which is something I've been talking about since my prior life. I think that the pieces are in place for productivity to really kill it. I think that's going to take time to develop.
Right.
And I think that, Lisa, is basically, that's another really important idea to insert into your question.
We got to go. When you go across the Hudson River, does Peters let you use the Hinckley picnic boat he's got? Are you using the little Hinckley thing that takes you over to PG?
I'm just happy to be around him.
Okay, Tom Porcelli, thank you so much. Say Robert Tipp as well. He'll be here later. Mr. Porcelli is with PGIM. Fixed income markets, I'm going to call it flat. Standard & Poor's 500 down 0.1%.
Right now, I'm actually looking up Hinckley because I have no idea what that is. I've got to be honest. What is that?
Hinckley picnic boat is
amazing
what
boats,
Porcelli goes large on it. It's got side turbo thrusters, so you can just ease into the dock and Nantucket.
Okay, good to know. This is I'm looking this up. This is probably gives you a pro
when
tip.
you get done with the Grand Banks, you get the Hinckley picnic boat.
So if anyone is tuning in and trying to figure out what time is making up and what he's not, or what he's projecting onto me,
Peters is gorgeous. He got the light blue,
all of these
the eggshell blue.
Boats, maybe you're projecting. Honestly, I'm just trying to put this all together and to understand the upside surprise in core, which was exactly what people didn't want. They thought we'd see an upside surprise in headline.
We got to.
I disagree, because it might be nothing burger right now, but put together with that 3-month rolling trend, just gives you this feeling that people are overestimating the downside surprises. Maybe this is what I'm kind of taking away from it.
I'm with Porcelli on this. I think the jobs day all of a sudden became more important here. Get out the calendar. We're, first week of October, we'll be to it. Stay with us with futures at -10. On radio, on television, this is Bloomberg.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody used my knife, I want them to say, damn! Golly, this is a badass knife.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
We think it's going to be a mild recession because in many ways we've already had some rotating recessions to come into this. So I don't think it's going to be as broad-based, but I do think that the consumer, being the biggest part of the economy, is going to have a digestion period. And that's what's going to lead to this mild recession. When I mean mild, I think it's going to last 6 months.
This is Larry Adam earlier this morning, Chief Investment Officer at Raymond James, talking about what a soft landing means, because we always are looking for definitions as people cling onto these words that have very different meanings depending on who we're talking about. We've seen the moves fade, Tom. It was a pretty significant move in some of the Treasury yields, in particular in the dollar, and it's kind of just sort of shrugged off as people take a look and say, it's a month.
I'm going to go all David Rosenberg on you. Rosenberg used to write at Merrill Lynch with Mr. Farrell, and about page 3 or 4 of his report, which was read street-wide, this is before the internet, Lisa, where theft was in order, and on the right side, he would list all the components of inflation. And the phrase I use is Rosenberg slices and dices like no one. It takes time to go through the 85, 90, whatever it is, slices and dices. So we're going to have a different view of this inflation report. Not here. Do we do a count-up clock? Once we do a countdown, do we count up afterwards? We're 17 minutes afterwards, and Rosenberg's, he's got a Labatt's poured, and he's like trying to get through it by 12 noon.
Well, the data now continues, but in more granular form. And you say, what goes up? How do companies deal with this? We did see airline tickets actually tick up in this latest report. As we hear about some of the margin compression at a number of them, I want to take a look just quickly at American Airlines and Spirit, which came out earlier today, revising downward their earnings outlooks. We saw EPS downgrades at American. We saw revenue downgrades at Spirit. Those shares down both 3.6%, 3.7%. They've come off some of the lows. But to me, this really highlights this question, what do companies do? As we were just hearing from Tom Porcelli, what do companies do when their input costs are going up and their prices are not necessarily being received well by consumers?
I get criticized. It's been a theme for me for 18 months. Corporations are going to adjust. They're adjusting in rapid speed now. And what the airline thing today signals to me is just the continuum away from the pandemic. It's like we're in some new phase after we all traveled like idiots. We're all the same on this. We all took the 7 flights we didn't want to take. And all of a sudden now it's now what for the airlines? I'm fascinated by what they say. I know we're speaking with Hurley from JetBlue here coming up on Bloomberg. She is grizzled financially about what do you do in the room when you face $93 Brent.
It's a larger story, though, also, because it's not just energy prices. We heard this from American. It's also labor. It is a pushback there. And these two polls are really creating a confusing toxic stew, which creates the situation of we don't know how companies are going to respond. Are they going to hoard labor, or are they going to take the Tom Porcelli route and start laying off some workers?
Well, the ambiguity of it's interesting, and it leads to the jobs report, and as a number of you said, emailing into me, the retail sales report tomorrow. Joining us now with wonderful perspective is Rob Waldner, Chief Fixed Income Strategist, Head of Macro Research, owner of the High Ground at Invesco. Is thrilled that he could join us today. Rob, ambiguity in microeconomics is you really don't know which way the curve is going to go. In fixed income, I got lots of ambiguities, mysteries, uncertainties right now. What's the lead ambiguity for you and Invesco?
Well, I think if we're trying to look at the ambiguities, let's look at where the market action today. So, I think, we saw that CPI was slightly disappointing from a fixed income perspective, i.e. core came in a little bit higher month on month than we were expecting. It keeps a disinflationary trend in place, but nonetheless, it was a disappointing number. And I think, as you pointed out earlier, you can't really tell in the market. The market's behaving very well. So I think that tells you that the market is not fully bought into this disinflationary trend idea, and tells you that the market is more worried about inflation than maybe it needs to be.
In a given bond portfolio, and there's 472 of them at Invesco, of flavors, I should say, of portfolios, the basic idea is you have to adjust. How do you adjust a bond portfolio now? Is it a duration dynamic? Is it a portfolio structure dynamic? What's the variable of action into the fourth quarter of this year?
Well, Tom, as bond managers, we really have two components to yield in our portfolios. One is the overall level of yields represented by the Treasury market, or real yields in the Treasury market, and the other is credit spread. And I think when we look at the balance now, going into the fourth quarter and going into 2024, We've been of the view that we would have a bumpy landing, but with a growing risk of a potentially slowdown in 2024, further slowdown. And so in that environment where we've seen real yields come higher, so the real yield component is higher, and the spread component has shrunk over the balance of this year, I think that favors putting more of your resources towards real yield. And we know that the market itself has been putting money into money market funds instead of into duration. We have, close to $1 trillion of money has flown into money market funds this year. So that tells us that the market is not valuing duration and real yield as much as it should be. And so we would be reallocating towards that sort of longer duration real yield into more traditional bond portfolios and using that as the core building block of our portfolio structure.
Let's build on that, Rob, because you said that what we have seen today in terms of the market response to today's report was that the market hasn't bought into this disinflationary idea, has not bought into this disinflationary idea, and that they're maybe more worried about inflation than they ought to be. How much are you loading the boat right now? Are you basically just going out and buying every 10-year Treasury note that you could possibly find, saying this is the time to lock it in because it's not going to last?
Well, we do think we're at the top of close to the top of the near-term range, Lisa. So, I mean, load the boat. I'm not sure we would definitely, we're getting overweight from a bond perspective in high-quality credit. And, we think this is a good buying opportunity.
When you say high-quality credit, I'm wondering how much we're also talking about corporate credit. At what point, when we talk about margin compression and this question of what do companies do with the fact that their costs are up and they cannot raise their prices commensurately, how much does that weaken corporate credit as opposed to improve it at a time when their revenues were increasing and they didn't have to refinance yet?
Well, so the fundamentals, I think you're driving here at the fundamentals behind the corporate sector. There's no doubt that I would put it slightly differently as you did, but I think I'm saying the same thing. No doubt that very high nominal GDP growth that we've had over the last couple of years has been very, very supportive for the corporate sector. Right. And as that nominal GDP comes down, so nominal GDP growth now in our estimation is running somewhere trending around 4 to 5%. So we're now down below the level of interest rates. That is going to put pressure on the economy overall, and including the corporate sector. So fundamentals will be less positive going forward, but the offsetting benefit will be if you're in longer duration bonds, that you will get some benefit from that duration.
Rob, I did a wonderful panel last week. We all didn't like her. She stole the show, which was unfortunate. But your Christina Capmany made real clear, as you stated, that with a reduced nominal GDP, a reduced animal spirit, things change. What will CFOs of corporate America do?
As that the problem is people will get squeezed. CFOs will get squeezed if they don't have that pricing power that Lisa was alluding to, which is the same thing as saying nominal GDP comes down. I think CFOs are in a pretty good place in that they've, as far as we can tell, in terms of financing, there's not a lot of near-term financing needs. So it'll be more of I think, Tom, it'll be more of a sort of longer term as things reset higher, squeeze rather than an immediate impact. But it is going to be more difficult to manage through an environment where your top line is not growing as fast as your funding costs are going up.
Rob Alder, thank you so much. With Invesco, Lisa, this is so important, and I'm going to go back to a huge mentor and someone of great influence on me, Philip Correa, who we enjoyed living to 104. He was brilliant. He was inquisitive. He founded Pioneer Funds up in Boston. And Mr. Correa would say to me, the young whippersnapper on the elevator, he would say, Tom, don't forget the bright lights of inflation. And under the bright lights of inflation, it's easier for CFOs. Inflation helps people feel in the real time that things are great. It's getting a little dimmer out there right now, is how I'd put it.
It's a transition moment. And what we're transitioning to is the really big question that we just don't understand. But it's getting harder for the CFO to understand exactly how to navigate.
What timing? Matthew Miller, in conversation with the CFO, the financial X at JetBlue, Ursula Hurley, perfectly timed given the challenges of the airline business. That tonight.
The names that move markets are on Bloomberg.
There's a complete change in the labor market. There's a complete change in the energy future that we are facing.
Under tightening would be a worse mistake than over tightening because we can course correct that.
The question is whether we need to increase the pressure or just keep pushing.
We've been getting good news. We just have to keep getting good news.
Nobody covers business like Bloomberg, your global business authority.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment cost agreement on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The smallest of upside surprises on the inflation report, and the drama in the market lasted about 20 seconds. Equity futures just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up, US CPI coming in stronger than expected. United Auto Workers are heading towards strikes, and Citi on the cusp of another huge restructuring. We begin with the big issue, inflation in America.
We're focused on inflation.
The CPI print.
CPI is important. Continues to be a very important thing that we talk about.
Firmer than expectations. But that still doesn't change the trend.
At the end of the day, we've had a great deal of disinflation.
The trend of inflation is actually moving slower.
Where does inflation finally go?
Does inflation continue to soften into the end of the year, or do we get a rebound?
We're certainly going to get some good news on the inflation front in the back half of this year.
It's a question of how the Fed interprets that.
What does the Fed do with that?
I don't think the Fed's really going to change the trajectory in terms of September.
The question will become the November meeting.
They're either on pause or they got one more hike.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
This is a very complicated time for the Fed.
A challenging environment for the Fed.
This is not going to be the last of the inflation worries that the market's going to have to face.
Joining us now to discuss PGIM's Robert Tibb, Torsten Slok of Apollo Global Management. Torsten, first to you, your view on that inflation data from 31 minutes ago.
Absolutely. The trend is moving in the right direction. There is a number of nuances here, looking in particular at supercore inflation, which the Fed has been focusing on, still at 4%. We see still a number of areas where inflation is certainly coming down, but most importantly, in services, there's still a number of question marks. In particular, you have a number of areas where you still see inflation moving up. So the conclusion to your question, Jonathan, is that yes, this is so far so good, but all these numbers, which are 3-4%, are still above the Fed's 2% inflation target.
Vishy Tirupattur of Morgan Stanley on this program yesterday, his line, the Fed has done enough. Robert Tibb, has this Fed done enough?
I think they have. I think we're seeing that in the growth numbers. And today's number was not an easy number, you know, to tell that story with the high headline. You know, some of the areas like the airfares, you're shooting up again. But when you get to the core of the number, if you look X, food, energy, shelter, you're looking at a pretty good 3 months where, you know, in total, you haven't seen a 1% annualized rate of inflation. That's something that was running at 4% in the prior 3 months. So I think there's going to remain some anxiety as to whether this drop in inflation is transitory, right? They're not going to feel really good about this until they see 6 months, 9 months of a good trend towards low core inflation. But I think this is good progress.
Robert, that's the risk, isn't it? Torsten, let's talk about it. They viewed the spike as transitory. They were wrong. Is the drop, the disinflation itself, transitory?
The key about that issue is that it's important to think about why is it, for example, supercore is still so elevated? Why is it not really coming down, in particular not on the PCE side? It's because the service sector is still doing quite well. People are still flying on airplanes, still eating at restaurants, still staying at hotels, still going to sporting events, concerts. That's why you see supercore inflation, meaning consumer services inflation, do quite well. So on a number of fronts, it is still for the Fed the case that they might still have to step a little bit harder on the brakes. I don't think we'll get more Fed hikes, but they still need to keep rates elevated to make sure that the service sector starts to slow down, because we haven't really seen that quite yet. And that's at the core of this discussion, namely, do we need to see goods only come down because the goods sector is back at pre-pandemic levels when it comes to inflation? But if we also need the service sector outside of housing to come down, then we do need restrictive monetary policy for quite an extended period ahead of us.
Well, Torsten, that's the question, isn't it? Are we sufficiently restrictive? You put out a deck. I've been talking about it the last couple of days over the weekend. Just fantastic charts. Charts after charts suggesting that we're starting to bite. Fed policy is starting to bite, maybe perhaps more slowly than we thought it would be, but it is biting. Are you convinced by that?
Absolutely. And the key issue here is it bites every single day. At the moment, every single day, there are companies who cannot get a new loan because interest rates are too high. There are companies who cannot roll over an existing loan. Likewise, on the consumer side, delinquency rates are going up on credit cards. Delinquency rates are going up on auto loans. Every day, because of the cost of capital being elevated, because the Fed has been hiking rates, there we are seeing both on the consumer side and on the firm side that it's beginning to bite, as you're saying, harder and harder. And if you think about it from a Fed perspective, this is the whole idea from the Fed. That's the reason why they're raising rates. They want us to spend less on our credit cards, to buy fewer cars, to hire fewer people in companies, to build fewer factories. So in some sense, this is exactly what the textbook would have predicted, that the economic data is exactly beginning to see the implications of Fed hikes beginning to show up.
Initially, off the back of this report, yields were higher. They're lower now. We're down by 2 basis points on a 2-year, still just above 5% on a 2-year maturity. The 10-year yield just about unchanged here at 4.29. With the data, let's get to Mike McKee for a little bit more. Mike, your view now, 35 minutes in. Are you seeing that sufficient progress Chairman Powell wants to see?
Sufficient progress, perhaps, to keep them on the sidelines in September. But there are things to watch in this report that would keep them on edge, perhaps, about November and or December. Let's start with the good news here. You see the core services ex-housing up 0.4%. That's the wrong one. I'm looking at the wrong one. Let me just call mine up here. This is core service. This is core. CPI core up 0.3%. 4.3%. That's the lowest since 2021. So on the core side, we are seeing progress, and that is good news because that's what the Fed's looking at, not these headline numbers that get distorted by gasoline. But speaking of getting distorted, we have some issues, and this is what I was talking about, where you're going to have to keep an eye on things. Rents and owner equivalent rent went up more than anticipated, and home prices are rising again. Is that going to continue? Used cars dropped, but what happens if the UAW goes on a large and lengthy strike? Airfares were up 4.9%, fuel and wages rising there, and gasoline, of course, everybody has seen that at the pump, 10.6%. Oil prices rising means gasoline prices continue to rise, and maybe that means that the Fed has a problem with inflation expectations. All right, now I want to go to the chart that I was talking about earlier, and this is the Supercore one that everybody wants to see. We saw it rise more than anticipated, up 0.4% on the month and up 4.05%, so call it 4.1% on a year-over-year basis, driven largely by transportation. And that includes the airfares that rose significantly, and also car insurance up 2.4%. So while we do have a rather benign outlook in the core for this month, we'll have to see what happens in September and October as the Fed considers what to do in November. And since you liked this so much yesterday, John.
Loved it.
There is no Barbenheimer Taylor Swift effect. Hotels and motels were down 3.6%, and admissions to movies and concerts were down 0.1% in August. So they did not push inflation higher. You can't blame Taylor for that.
Michael McKee, thank you, sir. Appreciate the update. We should get Morgan Stanley back for an update on that too. Mike McKee there breaking down the economic data. Mike mentioned energy, 92 on Brent, WTI at 88. Robert Tipp, this from Marko Kolanovic of JP Morgan this week. The potential for the commodity price surge to feed inflation and extend central banks' hiking cycles. Robert, how do you look at this? Is this a reflection of the extension of the cycle or the recipe to end it?
Oil is really important, and I think that if this looked like a sign of demand, of accelerating activity, that would be problematic. I think it's more symptomatic of the supply side. I think that when you look at the demand side of the economy, we're seeing the sluggishness in China, certainly, sluggishness in Europe, and frankly, in the US, these payroll numbers have been decelerating. The trend is pretty profound, and we're not talking about 1 or 2 months. We're talking about since the beginning of 2022, a very steady deceleration in the pace of job growth and a narrowing. So a lot of the job growth has been focused in healthcare, not in cyclical sectors. Those are coming, close to a trend pace, but you really need the line to bend here. You need the deceleration to stop in order to avoid a stagnation in the job market at this point. So I think you are getting a lot of cooperation on the inflation. Again, looking ex-food, energy, shelter, things have really calmed down. The jobs numbers have slowed, and the wages have really decelerated. So I think you're looking at a Fed on hold that is going to be looking for an opportunity to make that case that they have passively tightened and look for a window to cut rates. Our forecast is for next year, but frankly, it wouldn't surprise me if they were going to a pretty decent easing bias before the end of the year.
Well, Robert Tipp, with that in mind, BMO, Morgan Stanley, Wells Fargo, JP Morgan Asset Management on this program, they say buy the 10-year here. Robert, do you agree?
I think we are at the top end of the range. I think people are seeing a peak in the short-term rates. You can make the case that the value is not great, based on a 5.30 Fed funds rate. What do you want to be doing? Going out on the curve and giving up 100 basis points. But the real yields implied in this market, 2% real yields, those are seeing support. And I think that's what's keeping this curve inverted. Not really hardcore fear of a recession, but just the perception of value. So I think we're going to be looking at an inverted curve for some time. I think we are near the top end of the range in yields. That's the case we've been making for the last few quarters, that we've rewound here 2002 type levels. Yep. Yield is destiny. Outlook for the market is very favorable.
Near cycle highs right now on a 2-year and a 10-year for that matter. 2-year around 5%, 10-year around 4.30. Gents, stick with me. Robert Tipp, Torsten Slog. Your equity market on the S&P 500 doing okay. Some big moves over at Citi. Shonali Basak has that story. Hey, Shonali.
Hey, John, we're looking at the biggest restructuring at Citigroup in about 2 decades, because not only are they restructuring their investment banking trading units, they are restructuring the entire bank and its top management layers into 5 main business units that will report directly to CEO Jane Fraser. Now, in the early reactions, you are seeing a lift up in Citigroup stock. I did also just recently, right now, obtain a memo that Jane Fraser, the CEO, had sent to her own staff saying, I know many of you share my frustration that we are seriously underestimated as a bank. No one else has our global lens nor breadth of our insights and on-the-ground capabilities. Now, what does that mean? While they try to capture share, they are eliminating regional leadership roles. That means across the world, you may see significant job cuts among management ranks. That is according to our own sources. In her own executive management team, 19 members have been named. Now, in the investment bank itself, where she is trying to stay competitive, gain share, she named Peter Babay, the head of Asia Pacific, as the head of that business. But listen, John, that person will be stepping down, and Citigroup will be conducting a search for a new head of banking that will include that investment bank where Tyler Dixon is leading all the team's deal makers, and Jason Ricade, who is overseeing corporate banking, which Citigroup considers to be sort of their quarterbacks, the people who are across the world building relationships with clients and bringing in business. So significant day over at Citigroup, very large restructuring. This is just the tip of the iceberg. We have understood that it would be at least until the 4th quarter when we get more targets, financial results associated with these businesses, and targets in terms of what those headcounts could look like and the costs associated with them.
Shonali, we've heard from a lot of management on Wall Street in the last couple of days. There's a big conference taking place this week for Wall Street banks. Are we going to hear from Jane Fraser a little bit later?
That's the expectation. Currently, Mark Mason has been on the menu for that discussion, CFO of Citigroup, but we are understanding that Jane Fraser will make a surprise appearance and give remarks surrounding the big restructuring we're seeing over at Citigroup. Now, I will maintain she won't give financial targets, unlikely to give until the 4th quarter. However, this is a significant restructuring on top of the initial set of changes she's made over at Citigroup, exiting businesses around the world.
Shonali, thank you. The stock is positive by 0.9%. Stay close. We'll talk about this again around the opening bell, I'm sure. Coming up on this program, on the labor market, United Auto Workers heading towards a strike.
Never been so contentious, and I think that is probably the scariest part of all of this, that the sides seem very far apart. It feels like, you know, strike is likely.
That conversation up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
feels like, a strike is likely, this fragile chain can suddenly break again. And I think that's really what the scare is, because we're not thinking about doing this during a time where inventory has been bloated for a long time. We're talking about a time in which literally we're still in a recovery mode. It's, further along in recovery, but recovery nonetheless.
A united auto workers strike looking more and more likely. Negotiations between the union and Detroit's Big Three remaining far apart. Ford CEO Jim Farley telling Fox News the automaker is preparing for the worst.
We don't want to see a strike, but we're prepared to strike if we have to. It'll have a tremendous impact on the economy and our suppliers, but we're still optimistic we can work together through this.
And according to our reporting, the UAW president planning to confirm the union strike plans at 10 p.m. Eastern tomorrow. That's 2 hours before the contract officially expires. Joining us from Washington, Bloomberg's Anne-Marie. AMH, what's the latest?
Well, Jonathan, the latest is that potentially we will see this strike. You can see it there, what Shawn Fain is doing, preparing for that. We should know around 10 p.m. tomorrow whether or not he's going to pull the trigger and exactly which plans he is going to have these walkouts and strikes at. And at the same time, the Ford CEO said yesterday that they've come back with the best offer they've ever given the UAW in its history. But it still does not look like, Jonathan, that it is going to be enough. You see both of these party lines continue to harden. What we heard this morning from Shawn Fain on Good Morning America, Jonathan, is that he says that, yes, of course, potentially we can get there, but we're just not there yet. We've got 48 hours. That's not a lot of time. But more interesting, Jonathan, he's pointing to the fear-mongering that he says is out there right now. And he says how people are saying this is going to start to wreck the economy. He says it's not going to wreck the economy. It's going to wreck the billionaire economy. He goes on to tell Good Morning America that's the big issue here, especially in this country. The working class is living paycheck to paycheck, feeding off the scraps. And, Jonathan, that plays in today's inflation report. It's everyday Americans that are living paycheck to paycheck that feel like inflation is just eating away at their wages.
So on Thursday night, Anne-Marie, if that strike happens, are we getting a statement from this White House supporting it?
I'm not sure you're going to get a statement supporting it. What you will see is a statement likely what we saw a month ago, which was that they want to see fair and just wages for the UAW. At the same time, they want to make sure that these companies can be viable. They are really going to do their best to try to walk this down the middle. But it's going to be challenging, Jonathan, because time and time again, the president likes to boast that he's the most pro-union president in modern American history.
AMH, down in Washington. Anne-Marie, thank you. Torsten Slok, back with us with Robert Tibb. Torsten, I want to lean on a question I've asked before and give you an opportunity to answer it. Is this an example of the dying embers of a hot labour market, or is this a sign of more to come?
The issue is that since the Fed started raising rates in March of last year, we have gradually seen the labor market start to slow down. But it is still the case that the unemployment rate is at a very low level. We are seeing job openings coming down. We're seeing the quits rate, meaning how many people voluntarily quit their job every month, is also coming down. We're seeing the work week coming down. We're seeing wage growth for job switchers also coming down. So things are gradually softening, but we have not quite yet seen that increase in jobless claims or that increase in the unemployment rate that the Fed and the consensus had expected even just last year. So the answer to your question is that there's still relatively hot labor market, but a number of the leading indicators are pointing towards more softness. And that's what the Fed has been talking about for so long, and Jay Powell has been saying that they are interested in seeing a softening in the labor market. And with that backdrop, of course, I think that indicators are pointing towards that softening coming.
Can corporate America absorb any of this? We've been talking a long time about passing on higher costs to consumers. The price tolerance, has that basically faded away? This is what Ford had to say off the back of UAW in these negotiations. There is a line in the sand for the sustainability of the company. Robert Tibb, the airlines this morning, cutting the outlook off the back of higher fuel costs and in some places higher labor costs as well. Robert, do you think we can pass on those higher costs to the consumer, or are we at that point where they have to eat it and margins are going to get squeezed?
Yeah, it's not really a spiral, but I think you're going to have ongoing pressure with wages and inflation. It's not going to be a sudden stop. Right? People have lost a lot of purchasing power with inflation outstripping wages. The labor market isn't as tight as it's been, but it's tight. So you're going to see labor working to catch up. A very small percentage of the labor force is unionized, But the rest of the labor force is going to see these settlements and is going to try to get their piece of the pie expanded relative to what they've lost from inflation. So I think this is going to take a while. But I think the Fed has been very flexible on wages, recognizing that there are a lot of moving parts and that having a higher rate of wage growth may not be inconsistent with their hitting the inflation target. And, you know, the rate of wage increases that we saw from 2011 to 2021 were quite muted. We'd seen rates of increase in the ECI that were much higher, you know, in the 3.5 area, that were quite consistent with price stability. So, you know, we're at 4.5 year over year right now. But, you know, we have seen some deceleration. I think that all of this is consistent with a slow winding down towards target here in terms of inflation.
It's Austin, final question. Retail sales tomorrow. This from Drew Madison, MetLife, in the last hour. He said inflation trends unlikely to move in a way to prompt a change in Fed thinking. Retail sales more likely to change Fed thinking. Torsten, what will you look for tomorrow morning?
Yeah, I mean, combining the things that we're talking about here, everyone talks about a soft landing, but they really mainly talk about a soft landing in the economic data, including in retail sales. But we need a soft landing not only in consumption, in capex spending, and GDP, we also need a soft landing in inflation, and we need that at the same time. And that's the thing that we should be debating in markets. Is it possible to get that everything comes down Goldilocks style, where we get inflation back to 2, consumption starts to move sideways, everything is fine? Or is there a risk that, yes, the economic data might continue to slow, but inflation is just the more sticky and at risk of staying higher? And if that's the case, the Fed will stay restrictive for longer, and that will put more downward pressure than on the economic data. So it's the combination of the dual mandate of the Fed here of trying to get both a soft landing on retail sales, on the GDP, on the economic data side, and also a soft landing in inflation at the same time. And that's what I still think is not the most likely scenario. We should still continue to worry about the downside risk being more meaningful.
We make it sound so easy, don't we, Torsten? It's not, as you just said. Torsten Slok, Robert Tipp, to the both of you, fantastic, as always. 7 minutes out from the opening bell, equity futures totally unchanged. Coming up in the morning calls and later, US inflation surprising slightly to the upside. Morgan Stanley's Caterina Simonetti joins us at the opening bell, making a case for high-quality defensive areas of the market.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Stock's just about unchanged. Let's get you some morning calls. UBS upgrading forward to buy from sales, saying the impact from a potential strike will be short-lived and transitory. JP Morgan downgrading Oracle to neutral, growing increasingly concerned about the company's cloud business. And finally, Wedbush raising its Apple price target at $240, expecting new iPhone sales to surprise to the upside next year. Coming up, a stronger than expected US inflation report. That conversation with Caterina Simonetti of Morgan Stanley.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
23 seconds away from the opening bell in New York this morning. Good morning to you all. Coming off the back of the first down day in 3 on the S&P. We are totally unchanged on equity futures on the S&P 500. Likewise on the Nasdaq, following the smallest of upside surprises on the inflation report in America. Here's your opening bell in New York City. Switch at the board and get to the bond market. Yields were higher, then they were lower, now they're higher again. 428.62 on a 10-year, still near 430 on a 2-year, still near 5%. On a 2-year yield. The dollar just a touch stronger against the weaker euro. The euro in a world of pain. Let's sit there just for a moment. Stuck between a rock and a hard place. President Christine Lagarde. Germany set to revise its growth outlook lower for contraction for the rest of this year. And then on the other side of things, the ECB reportedly ready to upgrade its inflation outlook for next year to above 3%. What do you do with that? 107.47, Nomura looking for 105. In the commodity market, new highs for the year on crude, $89 a barrel on WTI. We're positive there by 0.2%. 40 seconds into the session, we're going absolutely nowhere on the S&P 500. Likewise on the NASDAQ. One stock to look at, it's Apple. Its launch event overshadowed by headlines out of China. The country's foreign ministry saying this: we've noticed there have been many media reports about security incidents concerning Apple phones. Ed Ludlow can explain this one. Morning, Ed.
Yeah, good morning, Jonathan. I would just point out Apple is modestly higher, 0.2%, and rebounding from that 1.8% drop on the iPhone launch event day 24 hours ago. If you don't mind, I'm going to read the quote again because this is a nuanced story. During a briefing, Chinese Foreign Ministry spokesperson Mao Ning said the following: "We noticed that there have been many media reports about security incidents concerning Apple phones." What happens in these briefings in China, John, is that there is a real-time Chinese or Mandarin exchange and a simultaneous English transaction. And what we note in our Bloomberg report is that the English translation omitted the phrase media reports. The significance is this is the first time that China has publicly acknowledged the reporting by Bloomberg and others that China's central government has instructed government agencies and state-backed enterprises to inform staff not to use a foreign handset, including iPhones, and to switch to a domestic handset. What is really important with this story is that the spokesperson, Mao Ning, went on to say that China has not issued laws and regulations to ban the purchase of Apple or foreign brand phones. And actually, if you look across the media landscape this morning, many outlets leading on that there is not, according to this spokesperson, an outright ban. Shares up now 0.5 percentage point. Remember, we got exactly what we expected at that iPhone event yesterday when I was down in Cupertino. iPhone 15 Pro, $999. If there was any surprise, and this is what the sell side's jumping on, it's the slightly higher price point of the 15 Pro Max, $1,199 or $1,200. But with the starting model having 256 gigabytes of storage, they want to see them use the lever of the higher prices, knowing that driving unit volume growth is really hard for Apple right now. It was an all-singing, all-dancing, bells and whistles phone, John. It's exactly what Mark Gurman reported it would be, and it was a classic iPhone event down in Cupertino.
Ed, you and Gurman, great coverage in the last 24 hours. Thank you, buddy. Ed Ludlow there on Apple. Let's turn to the auto sector. The EU launching an investigation into Chinese subsidies for EVs to ward off cheaper imports. European Commission President Ursula von der Leyen saying this: their price is kept artificially low and it's distorting our market. Abby has more. Hey, Abby.
Hey, John. Yeah, pretty protectionist behavior here out of the EU toward China and the China EV makers. They are launching an investigation into Chinese subsidies for EVs. And the reason really has to do with the growth of China EVs, sales of China EVs in Europe. In 2020, they had 1.1% of the market. Now in 2023, they have 5.6% of the market. So over just a couple of years, 4.5% growth. And of course, there are many German automakers, BMW, Volkswagen, Audi, Daimler, that have EV vehicles to sell, many of those starting above $100,000. So the EU really looking into whether or not these subsidies are helping China and those China EV makers take share. It's not clear whether or not actual tariffs will come from this. Earlier, the German automakers had been higher. Now they're basically about flat. On the fear, will China retaliate relative to the stocks, John? It's interesting because on the year, NIO up about 6% on the year, BMW up about 16%. So it seems as though the EU probably not thinking about share prices, but potentially this could protect investors of those automakers as well.
Oh, this is so important, Abby. Thanks for this. This connects to the story here in America as well. How do these names compete with rivals in China on a cost basis, particularly with this UAW dispute taking place as well? This line from Mr. Farley over at Ford: there is a line in the sand for the sustainability of the company. They're thinking about how they can compete with Chinese EVs as well. We're about 5 minutes into the session. We're just about positive by 0.2% on the S&P. On the NASDAQ, up by 0.1. I want to turn to the airlines. This was big news earlier this morning. Spirit and American both cutting their forecasts, citing a rise in jet fuel costs. Spirit also citing heightened promotional activity and steep discounting. Those stocks getting hammered over the last few months. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, higher fuel costs going to cause both Spirit and American to adjust either their revenue or their earnings per share forecast. Spirit slashing its revenue forecast for the third quarter. It was looking for $1.3 to $1.32 billion. Now it's looking for $1.245 to $1.255 billion. This on a jet fuel costs estimated to be at $3.06 per gallon. That's about 26% higher, 26 cents higher than it had previously anticipated. Talking as well about that lack of demand, that steep discounting that it's been doing, especially seen it in the past 3 weeks, going to extend, it says, through the pre-Thanksgiving period. American also seeing now $2.90 to $3 per gallon jet fuel costs in the third quarter, that forcing it to cut its adjusted earnings per share from 85 to 90 cents or 95 cents to now 20 to 30 cents. Also saying it's got to account for some of those payments of roughly $230 million to airline pilots under its new contracts. We saw some of the reflection of that the falling airline fare costs in the CPI data this morning. Airline fares down 13.3% from last August, and this really taking a hit on all of the airlines in trading today.
So we're told, we're just not feeling it quite yet, Simone, but I trust the data. Hopefully fares are coming down because we all want them lower, don't we? Simone, thank you. This market picked up the scent of this story over the last couple of months. Airline stocks on the S&P 500 down by more than 22% from the highs of July. More than 22%, that move lower off the back of these negotiations with the labor story. Airlines, American Airlines, I'm thinking of them. Higher jet fuel prices off the back of this move in crude in the commodity market. I'll give you the update at the moment. WTI just short of 89. Brent crude through 92. Let's finish on the banking sector. Citi preparing for a wave of job cuts as it restructures to operate from 5 main businesses. The Wall Street giant saying this: as Citi swiftly transitions to this new model, the firm is committed to retaining top talent and supporting employees who are leaving the company. Shanali has more. Hey, Shanali.
You have Jane Fraser, the CEO of Citigroup here, John, just taking an axe to Citigroup's management structure, now having 5 business heads with all of the groups rolling up to those 5 in particular. Now, who does that include? It includes the unequivocal trading and markets head, Andrew Morton, as part of that team. And very surprisingly here, you have Peter Babet, the head of Asia Pacific, now becoming the interim banking head, leaving open a position at Citigroup and putting them on a search for a new division of one of the top 5 M&A, IPO, and debt underwriting advisors across all of Wall Street. Now, this could be pretty painful for a lot of managers across different divisions over the next couple of months as they figure out just what other layers beyond this top 2 start to go away. Initial reaction from the market is they like it. This may result to a very streamlined bank after Citigroup has already exited certain markets. They don't have yet financial results across these new business lines or a target of what that full workforce reduction would look like or the severance costs associated with those reductions. But at the end of the day, a year from now, you might have a much more streamlined Citigroup.
Brilliant reporting, Shanali, through this morning. Looking forward to more from our chief Wall Street correspondent on the latest on Wall Street with Citi. Want to get to Morgan Stanley's Caterina Simonetti, expecting late cycle sectors to outperform and adding this: pay attention to fundamentals, stick to quality, and have a longer term investment view. Stay disciplined and recognize the pullbacks in the market as potential buying opportunities. Caterina, I'm pleased to say, joins us now. Caterina, let's start with this phrase, late cycle. I've said over the last few months, it feels like the economist who cried recession through the whole of this year. I was told late cycle. Why are we well and truly in late cycle?
Well, John, thank you for having me on the show. And one of the things that we're seeing right now is this very conflicting data. And let's take a look at the inflation numbers this morning, right? You know, on one side, we see inflation coming down, but we also see parts of it that are still up, which is very concerning to consumers, like energy, real estate prices, rents, the services, travel. And this is very typical of the late cycle where we see this conflicting data. Unemployment a few weeks ago, you know, actually is coming down. At the same time, we see enormous pressures on earnings and profit margins, and we're expecting, you know, that to be translated into, you know, some of the dips before the end of the year. You know, so therefore, in our view, we think that we are in this late cycle, you know, which means that, you know, on the flip side of it, eventually things are going to start getting better, but we're not quite there yet.
Caterina, let's build on that and stick to energy just for a moment. Brent at 92, WTI just short of 89, 88.90 something this morning. Energy stocks on the S&P so far this month before today up by more than 4%. Is that a move I want to stick with or a move I want to fade?
Well, Jonathan, so far this year, the stocks that performed were this magnificent seven, right? The area that already was the leading sector in the last bull market. And yet, we were kind of all on the bandwagon that was going to be the sectors to stick in. And what we think that investors should stay with quality. They should be fully invested through this market cycle, but at the same time, they need to stay defensive. And one of the top areas in this defensive play would be energy, because a lot of energy stocks pay good dividends. We use a lot of energy. We all drive our big cars, especially here in the United States. So the energy use is there. And we think that energy definitely plays a very significant role in the portfolio, along with financials, healthcare, industrials, materials, all of these are sectors that we would like to see in portfolios because we like the positioning, we like valuations, and we also like the fact that these sectors are paying very good dividend yields, which is important.
They're the price makers as well in energy. So let's talk about the price takers, the airlines. The airlines at the moment have to absorb those higher energy prices that we've been talking about. And what we've seen this morning, what we've witnessed, are basically downgrades, cuts to the outlook at Spirit, at American Airlines. Katerina, I know you can't do single names, but for the sector, for the airlines, what area of discretionary spending do I want to be in right now? What do I want to avoid?
Well, I want to answer your question with focusing on consumers. And consumer has been under tremendous amount of pressure. The inflation is real, and, seeing the prices go up, eventually kind of curb that enthusiasm that we saw, coming out of COVID, where, we were so deprived of travel and we wanted those experiences, and we see the prices of air travel going up. But how much longer can it last? Specifically as we're facing the reality that interest rates might be higher for quite some time, and that we see the companies cutting costs, we see layoffs, and all of that really puts pressures on consumer confidence, where, they might be a little bit more reluctant to spend money, on this excessive cost of travel, and we see the incentives, we see prices of the airline tickets coming down, but not enough to really incentivize people to continue to travel quite at the same rates as they have been. So this is the sector that we are telling our clients that they should probably avoid for a while and stick with more defensive plays.
Bank of America this morning, tight labor market, solid balance sheets, lower income resilience, and goods deflation leave us constructive on the consumer. Katerina, your story, do you expect it to show up in the retail sales number we get tomorrow morning?
The retail sector is a little tricky because, again, when we look at the inflation and when we look at the data that is coming out, that's the first area where if you're going to save some money, what are you going to continue spending on consumer staples, on energy, on healthcare, on things that we absolutely cannot go without, but we see the weakening in retail, and it will be interesting to see what the numbers are going to tell, if they're going to support the story, but most likely we're going to see some weaker numbers.
We'll see. Katerina, thank you. Katerina Simonetti there, the latest from Morgan Stanley, looking ahead to that retail sales print that we get tomorrow morning. Coming up on this program, the IEA's crude warning.
With the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk tightening the market, increasing volatility.
Team coverage up next with crude prices at 2023 highs.
Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Market is really tightening in the second half of the year. Already in August, we saw global oil inventories falling by a massive 75 million barrels, according to preliminary data. And with the extensions of the cuts by Saudi Arabia, but also Russia through the end of the year, we're seeing global oil demand overtaking supply by about 1.4 million barrels a day in the fourth quarter. So this risk, tightening the market, increasing volatility.
The IEA warning that Saudi and Russian production cuts will create a significant supply shortfall, writing this: oil stocks will be at uncomfortably low levels, increasing the risk of another surge in volatility that would be in the interest of neither producers nor consumers, given the fragile economic environment. The announcement coming as Brent hovers at 10-month highs above $92 a barrel. Your team coverage starts right now with Bloomberg's Anne-Marie alongside James Herron. James, can you talk to me about how big that supply deficit is going to be later this year?
Yeah, well, the market's already tight, and it's looking like it's going to remain at least just as tight. You heard the number from the IEA there of 1.4 million barrels a day in the fourth quarter. Interestingly, the numbers from OPEC actually are almost twice as large for the supply deficit, largely because OPEC has a much more bullish view of demand. So really, the difference may come down to how the economy's doing, and very particularly how China's doing.
James, do we have a decent idea of how that demand picture looks like, what it looks like in China currently?
Well, you know, there's been a lot of talk about China's weakness, but some analysts who've recently been reporting on China, some who've even traveled there, are saying that oil demand is stronger than you would think, given the weak state of the economy, and there may even be a decoupling between the strength of oil demand and the broader economy there. So perhaps the more bullish estimates of Chinese demand will turn out to be correct.
Anne-Marie, the president would like a good story to tell about inflation. Does this crude market complicate that?
Oh, it certainly does, Jonathan. And the cherry on top of the cake for that has to be today's inflation report, with gasoline being the single biggest contributor in overall prices moving up in August. And when it comes to the psyche of the American consumer, there was a survey done last year. Remember when gasoline prices over the summer were about $5 a gallon? The issue is that when consumers see higher pump prices, which are on every side of the road, it starts to affect how they are going to use their paycheck to paycheck. How are they going to decide what they are going to buy? And it starts to impact actually some of the feelings they have about their pricing power, their purchasing power in the United States of America. The president, the latest polls show he continues to get poor report card when it comes to his handling of the economy. Quantitative says it's only a 36% approval rating on the economy. And the biggest issue for him is inflation and gas prices. That is going to be a very difficult one for them to really try to sell Bidenomics on if the pump prices are going up.
James, final word. This is happening with crude output in America near record highs. It's happening with the SPR drained after the events of the last 18 months or so. James, just how vulnerable is the US to a price shock with all of that in mind?
Yeah, as you say, there really aren't a lot of levers that the Biden administration can pull, especially when the relationship with Saudi Arabia doesn't seem to be on particularly good footing. As we know, last year, the White House was pressuring the Saudis to open the taps, and they did the exact opposite. And there's no sign of any shift in that relationship right now.
WTI, 88.50. Brent crude, just short of 92 now. Breaking down a touch, 91.90. AMH, James, thank you for the latest in the crude market. Let's get the latest in the equity market, some sector price action. Here's Abby.
And the sectors this morning are pretty evenly distributed to the extent that they can be, given that there's 11. But the reason I say this is we just have a few, one more that is lower. Energy down about 0.6%, with oil's small decline, and then 5 higher, but consumer discretionary up just about the equal amount to the upside, being led by Amazon, Tesla, Ford, and others. As for those airlines, though, John, let's take a look at that decline you were talking about off of the July peak. It's really pretty brutal. So American Airlines today, not really completely not priced in, not new to investors, basically a bear market over this time period as investors do worry about these rising costs. And will airlines be able to manage them, and will there be demand from travelers?
Abigail, I'm with you. This market's been there already. It picked up the scent of this news that we got this morning. We're down over the last month by something like 8%. And based on that chart that Abby just put out, from the highs of July, we're down more than 20% from the highs of July for that industry group. About 23 minutes into the session, we are positive here by 0.1% on the S&P, on the Nasdaq up by 0.1% also. Inflation data, the tiniest, the smallest of upside surprises on core CPI, drove yields a little bit higher initially, then that move faded pretty quickly. Yields on a 2-year lower by 2 basis points, just above 5% at the moment on the 2-year. On the 10-year, down about a single basis point, still in and around 430 at 427. Up next on this program, your trading diary.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this
this role, it's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
"25 minutes into the session, you know what we say, no drama here really on the S&P 500, up by 0.1%. Similar move on the Nasdaq, some slight underperformance again on the Russell, the small caps pulling back by about 0.4%. That's the price action. Let's get to the calendar. This is how things are shaping up in the trading diary. Thursday, tomorrow, initial jobless claims, US retail sales, and an ECB rate decision, plus the UAW strike deadline at midnight. Friday, some economic data out of China, including property prices and industrial production numbers. Sneak peek of next week, next Tuesday, President Biden in New York for the UN General Assembly. And on Wednesday, the main event for us on Wall Street, a Fed rate decision and Chairman Powell news conference. All of that around the corner still to come this week and beyond into next week as well. From New York, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We got some green on the screen today. Inflation data came in generally in line with expectations. Coming up, big restructuring at Citibank. We'll break it down with Allison Williams from Bloomberg Intelligence and Shonali Bosick, our Wall Street reporter for Bloomberg News. So that's good stuff there. Plus, we're going to have Stefan Bancel in studio here. He's the CEO of Moderna. He's going to join us in studio. They're having a big R&D day for the company, so maybe some announcements there. We'll get a sense of, we got a new booster coming, I think, and the question is, do we need to get that? So we'll check in with the CEO of Moderna. Plus, Kara Murphy, CIO at Kester Investment Management, with her market call after that CPI print.
A lot going on.
There's a lot going
Just
on
jam-packed.
here. Jam-packed. Eric Malo knocking the cover off the ball here. We're going to start things off with a Bloomberg Business Flash with Karen Musk.
All right, Paul, thank you. Well, we're looking at stocks. They're higher. That's following that mixed inflation report, which is reinforcing speculations the Fed will pause its rate hikes but refrain from calling the end of its tightening cycle. And we check the markets all day long here on Bloomberg. The S&P 500 up 0.2%, up 7 points at 44.69. The Dow Jones Industrial Average up 0.2% or 75 points at 34,722. And the Nasdaq up 0.2% or 28 points at 13,802. 10-year Treasury up 1/32. Yield 4.27%. The yield on the 2-year is at 5%. NYMEX crude oil little changed at $88.85 a barrel. COMEX gold little changed at $19.3560 an ounce. The euro 1.0739 against the dollar. The yen 147.46. With the so-called core consumer price index, which excludes food and energy costs, advanced 0.3% from July, the first acceleration in 6 months. From a year ago, it increased 4.3%. That was in line with estimates. And Torsten Slok is a partner and chief economist at Apollo Global Management. And we will check back in with him in just a moment. Here is Torsten Slok. And again, we will check back in.
The trend is moving in the right direction. There is a number of nuances here, looking in particular at supercore inflation, which the Fed has been focusing on, still at 4%. We see still a number of areas where inflation is certainly coming down, but most importantly in services, there's still a number of question marks. In particular, you have a number of areas where you still see inflation moving up.
And that is Torsten Slok. And that's a Bloomberg Business Flash. Paul and Matt.
All right, Karen Muskow, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. We had the futures are kind of mixed today on the back of that inflation print, but now we're decidedly in the green here. Let's see what's happening under the
How
hood.
weird is that?
I know. I think it's
just so weird.
Well,
so
it's
inflation comes in stronger than expected.
A smidge stronger than
Yeah, but still much stronger than it was last month.
Yeah, but there was gas.
I mean,
and insurance and stuff like that.
I just don't see how
systemic is that?
I mean, I think inflation looks like it's going to be stubborn up around 4%, or more.
But do you
talking
need
about the core, right?
Yeah, but do you need to raise interest rates on that data, or can you just kind of let the long and variable lags work with the interest rates?
Well, they already wanted to raise interest rates. If you look at the dot plots, there's still one more to go.
See, but they're not listening to me, which is we're fine right here.
All right.
You need to listen
Let's
to
ask Bailey Lipschultz.
Let's ask Bailey Lipschultz. He covers all these markets for Bloomberg News. Bailey, what are you looking at today?
No, I was going to say, Paul, as you mentioned, it's really looking at the reactions from analysts, investors, strategists is pointing to gas is the big driver for that headline inflation number. So unlikely, according to them, to show up again next month. When you look at that warp function, feels like there's not much change relative to yesterday in terms of expectations for a hike.
I just want to jump in and point out that for my entire life, and I'm old, the Fed has looked at the core. They're aiming for core inflation at 2%. So that's ex food and energy. Gas, by the way, falls into the latter category, right?
Oh.
So it's not the headline that matters to them, supposedly,
It almost feels like this is a market, Matt, where people want to be talked into buying, though. So
Yep.
if there's any reason you look at that knee-jerk reaction, oh no, and then all of a sudden futures popped right back. So wanting to shake it off. But when you're looking at some of the outperformers, I know you guys are going to talk to the head of Moderna. That stock right now up nearly 7%. This coming after strong data for its flu shot, something that they may get on the market, may get approval for sometime next year. Also, I'm interested in when you guys talk to the head man there, laying out expectations for sales from $8 to $15 billion of expected sales from a respiratory franchise in 2027. So 10 to $15 billion in new annual sales by 2028 from new products in oncology and rare disease. Still quite a bit away, looking 5 years ahead in the biotech industry is a bit risky, but those are some big numbers.
Yeah, some big numbers and seen that move. I don't know. They offered a flu shot here at Bloomberg down on LL2. I go down every year and get the jab. Why not?
I get it too.
Yeah, why not?
I don't know.
I'm a very brave
how much it
patient
helps.
as well, by the way. No crying, no sobbing when I get my shot.
I need
very
to hold
strong.
someone's hand if I'm going to get a shot. I need to squeeze.
Okay, so I'm sure the people that deliver the shot appreciate that.
Yeah. Well,
All right, what else you got for us, Bailey?
Obviously, airlines under pressure. American Air down 4.3%. The S&P 500 airline index, ticker S5AIRL, down.
I'm sure the listeners are
typing that.
Yeah, as they're driving.
AIRL index
down 3.5%. American Air down 4.4%. United down 3.5%.
And why is this fuel costs, labor, that kind of thing? It's on the cost side, right?
Cutting their profit outlook on higher labor and fuel costs, so a double whammy. Basically looking at bearish commentary from American Air. This also coming as Spirit Airlines cited some steep discounts that they're giving for travel ahead of Thanksgiving. So it does seem like some of that optimism, that revenge travel, maybe not playing out with.
Well, see, Tom Keene, he lives a different lifestyle than we do. He doesn't fly to like Louisville, Kentucky. He prices out round trip business class for two to Paris. Yeah. And it was 14 grand like recently. Now it's under 7. Ooh. So that's kind of the data point that Tom Keene brings to the table.
That's for 2, or you mean per person?
I don't know.
Because I just priced out literally a half hour ago a round trip to Vienna, business class for 1.
Who's going to Vienna?
Well, I would like to.
Why?
And because I've been invited by the CEO of Mercedes.
Oh, you have to go.
To drive the new electric G-Class. I know, I would be the first person pretty much outside of the company in the world.
Oh, we got to get
to
that
drive
done.
it along with Hannah Elliott, because I want her to go with me.
Sure.
So
all right,
anyway,
round trip to Vienna,
$11,115. Now, to be fair, it's Vienna. It's not a hub. London, Paris, Munich are going to be cheaper.
Can you go direct from JFK to Vienna?
Yeah.
Nice.
United has a flight direct.
We're sending you over there.
I'll
make a note of that.
Now, if I flew economy, it would only be $2,300.
But you're 6'3"?
6'3".
Yeah, no way. You're not flying economy.
And almost 50 years old. I don't want to fly in economy class.
He's a player. He's a TV personality.
Yeah, there you go.
All right, so the airlines are under pressure.
Airlines under pressure. One of the stocks not reacting as strong as maybe anticipated, Citigroup, after laying out plans for job cuts, revamping their top management structure. Up 0.7%, kind of a modest outperformance in what's a relatively flat tape. So a bit of a change there. But as I know we've talked about in the past, IPO season starting to kick off. ARM expected to price after the bell of the day. So all eyes will be on the SoftBank-backed chip design.
And we expect a full, strong book, right? So to me, it's going to be how this thing trades tomorrow. Boy, I'm glad I'm not making the market tomorrow in this thing, because all the pressure in the world is on the trader who's making that market, opening that stock.
It's going to be an interesting one. You got a tight float. You've got cornerstone investors.
This thing could rip.
It's gonna. There's a lot of excitement, a lot of though, from the people I talk to.
All right, we'll talk to you about that.
By the way, you're gonna watch. Keep your eye on the car makers, dude, because tomorrow's the last day
of
negotiations.
Oh, that's right. Yeah, tomorrow night,
11:59 p.m. apparently is the deadline. I'm watching close. But Ford and GM, they've been up the last couple of days.
Ford's up today, double upgrade over at UBS.
Oh,
talking up earnings resilience. So
okay. I don't know. That doesn't sound right.
You got to have cojones to upgrade the stock 24 hours before a potential strike.
Yeah, could be big. And it doesn't sound good, right?
Does not sound.
No, it does not.
The only thing is the president of the United States of America says he doesn't think there's going to be a strike.
Oh, well, there you go.
And he's the leader of the free world.
Maybe
so you think he knows more than we do. We'll see if he's right.
Okay, very good. All right, Bailey Lipschultz, thanks so much for joining us here. Bailey Lipschultz, he covers the markets for us. All right, some big news out of Citigroup. Our good friends over there at Citigroup, former employer of mine. Big restructuring. There's going to be some headcount reductions. Let's break it down with two people who really know this stuff. And that is Shonali Bosick. She covers all Wall Street for Bloomberg News. And, of course, Allison Williams. She is our senior banks analyst at Bloomberg Intelligence. Allison, thanks. You join us Zoom. Shonali's here in studio. Allison, start with you. How big of a deal is this for Citi? You've covered this stock forever.
So I think, I would characterize it as a reorganization, perhaps versus a restructuring, where
that's good
I think they're just really trying to, clean up the reporting lines and maybe help management to be a bit more focused. And also, showcase, as an analyst, I'm excited to get cleaner reporting where we can, finally see what's happening with their private bank, with their wealth unit. There was some hints at this over the summer, and even prior, I guess, with some of the hires that they made. And I just think it's, another step in Jane's journey, if you will, in terms of just making this a cleaner, more focused bank, and hopefully getting to the efficiency that investors have long wanted them to get to.
So, Shonali, is this going to help Jane Fraser boost the stock price? Because that's bottom line, right? And I'm looking at, over the last 5 years, they're down 30%, whereas Goldman's up 63%, Morgan Stanley has more than doubled.
It's certainly a tough story for Citigroup. We have had her first set of restructurings here, if you will, where she let go of certain consumer businesses around the world. And now what is difficult for Jane Fraser and their investors of Citigroup is that there are still a lot of unanswered questions about this reorganization. One being how many jobs will be lost underneath the surface. Our sources say that there could be significant headcount reductions here because what Citigroup is doing is removing layers of management. And this announcement only addresses the top two layers. The reality is they're going to be looking across management around the world, across divisions. One of the things they did in this reorg is they got rid of many of their regional divisions here.
Okay.
So the way you think about Citigroup now is that there's Citigroup North America and there's Citigroup International. And you now have 5 main business lines. It's no longer just the main 2, which is institutional client group, as well as the consumer offerings. Most of that consumer business now is the United States, North America.
Okay.
So there was a real reason that they needed to do this. Citigroup today does not look the same as Citigroup 2 decades ago when the initial set of current structure is what you see. In a way, you can see this as the most significant reorganization in 2 decades because this is really getting rid of the groups that we have known for so long at Citigroup.
Well, it strikes me, Allison, as it came out of my mouth, I realized probably Goldman Sachs and Morgan Stanley aren't the best comparison to Citi in terms of stock price performance. Wells Fargo over the last 5 years is also down, only 10%, not 30%, but also down. Bank of America over the last 5 years is only up 8%, so not down 30%, but up 8%. Are those better comparisons for Citi?
I think they are. I think at the end of the day, when we look at all of these banks, the way that investors think about it is, the valuation is going to be tied to returns, as it should be, right? And so someone like Morgan Stanley that you referred to, the comparison that you could make is they've improved their structural returns through moving towards the wealth business. Looking at someone like J.P. Morgan, who's a very different bank, they're actually executing, above all of their peers. Part of that is the scale that helps the profitability across their businesses, and they have leading returns. And so the struggle with Citi, and I think, part of the reason why it's been tough for the stock is they just have not been able to improve the returns. And if you look across the group, their returns are the worst. Wells Fargo, during certain periods of times, with all their big charges, had some weaker returns, but they're sort of on the path to better profitability. And so that's really what Jane needs to deliver on at the end of the day. It is those returns. And I think why this is important is, as you clear the structure And that's been one of the biggest issues of Citi is all the bureaucracy and really sort of a messy organization. But if you can get that cleaner and you can improve the efficiency of those core businesses, they do have some good businesses to work with, some high returning, what should be high returning businesses.
Shonali, what do you think Jane Fraser wants the message to be about Citigroup? And I think of like Morgan Stanley, I think of James Gorman, pivot towards wealth management, so successful. What do you think Jane Fraser would like that view of Citi to be?
On one hand, it's simpler for James Gorman to sit there and say, we're an investment bank and we're a wealth and asset manager. Yep. For Jane Fraser, it's a different story. Her goal here is to have all of her managers essentially get one message, which is get leaner. Mm-hmm. They have one of the largest investment banks in the world, but just take the M&A business, for example. The reason I bring up the M&A business is they are sitting at number 6 in the league tables. Actually, I just looked at it and got kind of stunned because they're behind Centerview, which is a lot, and that is in terms of deal volumes. Yeah. And that, a year, 2 years, 3 years ago is just a stunning thing to see this late in the year. And so the share that they need to gain to keep those fees up, as well as squeeze every dollar out of the cost that they have, it's a twofold story. It's one, get competitive and win. 2, be more efficient with every dollar we have to improve profitability. And so, the investment bank is a really good example because in this reorg, one open question among those 5 business leaders is who will run the investment bank over at Citi, the banking business. Currently, they have tapped an interim head, Peter Babet, who is the CEO at the Asia business. Yep. You have to consider this. This is one of the top 5 M&A businesses in the world. Yep. It is one of the hottest jobs on Wall Street. And guess what? They have a huge IPO business, a huge debt underwriting business, and that person, you can't imagine, wouldn't one day be the successor for Jane Fraser herself. Well, again, they have a consumer business that's quite large as well, but they have a massive investment bank, and it is a seriously competitive spot.
And my buddy Tyler Dixon, still running the investment bank over there, so he's
now under the new banking head.
I know, that's interesting, but Tyler's just one of the smartest guys in the room, every room he's in. Shonali Bassick, thank you so much. We got Allison Williams, thank you so much as well. Let's go to Karen Moscow right now for our Bloomberg Business Flash.
Yeah, Paul and Matt, watch the stocks turn lower, and now they were higher for the open and the start of the morning, but now again they're lower after that mixed inflation report. S&P 500 down 0.2%, down about 8 points. It's at 44.54. The Dow Jones Industrial Average down 0.1% or 36 points at 34,611, and the Nasdaq's down 0.25% or 35 points at 13,738, and the 10-year Treasury up 2/32, yield 4.27%. That's a Bloomberg Business Flash. Paul and Matt.
All right, Karen Moscow, thank you so much. We appreciate that. Lots going on here today. We want to pivot hard here, and we want to talk pharmaceuticals, and we want to talk drugs and all that kind of stuff, and we can do that.
Well, and one of the biggest winners of the day.
Winners of the day. Stefan Bancel, CEO of Moderna. That is a NASDAQ-traded stock. MRNA is the ticker to put into your Bloomberg terminal. Nobody, I guess when you sit around your Thanksgiving table, everybody likes to just complain about drug prices, right? Everybody does it. It's across the aisle. But I turned it around a couple years ago and said, okay, we can do that because we always like to complain about drug prices. But these guys in the pharma and the biotech industry, man, did they come through with COVID.
Yeah, I think actually as a society, we were all a little bit relieved.
I'm like, in 12 months, these guys came up with a vaccine? I mean, who does that? But you guys did. Thank you very much. Thank you to the Pfizer folks and all the other pharma and biotech folks out there that, man, did they come through with that vaccine. Appreciate it. Now what do you do with Moderna? Tell us, you guys have your R&D day today. You bring out all your new stuff for your investors, for your stakeholders. What's the big message for your R&D day today?
Is that we're not a COVID company. And
yes.
Thank you for the kind words.
Yes, but thank you, though.
An mRNA platform company, and the platform is firing on every cylinders. Today, we're announcing positive flu data in phase 3. So if you think about it in terms of vaccines, we are 3 out of 3. COVID working, RSV filed to the FDA, and today positive flu data. In cancer, we have now products showing 44% improvement versus the best drug available to patients today, which is immunotherapy. In melanoma, skin cancer, and we're going to start before the end of the year a phase 3 study in lung cancer. So cancer, we really want to transform as well.
Is that by the way, because of mRNA technology? And I'll just remind listeners, we are talking with Stefan Bancel right now. He's the Chief Executive Officer of Moderna. And as you said, you're not just a COVID company. You did have an mRNA vaccine for COVID that maybe saved the world a lot more pain than it would have seen. But you also have a flu vaccine that is driving the stock up today 6.5%. And cancer treatments that we all hope, I think, are going to be successful and could drive revenue another $15 billion starting in 2028. So tell us about the mRNA technology that we all kind of learned about a couple of years ago.
Sure. So mRNA, as you learned about, is an information molecule. We basically code in that molecule what protein we want your body to make. That will be your drug, your medicine. And in cancer now, what we have shown is a huge impact on survival and being able to not have recurrence of disease compared to the best drugs available today to patients. And the third chapter for us after infectious disease vaccine and cancer is rare genetic disease. We are now 3 out of 3 rare genetic disease showing positive data in kids with those diseases that have no hope today. Zero hope.
All right, so back to the flu, because we're getting into flu season. What is your flu vaccine? What is new? What is different? Just tell us about what you guys are bringing.
What's driving the stock today? Why are people so excited about the flu vaccine?
Because first, we're going to be able to participate and provide a very high efficacy flu vaccine. What we've showed in actually other studies is that actually it's as good as the best vaccine on the market for flu. But what people I think are excited about is the idea of combination, meaning we're going to show before the end of the year flu and COVID combined in a single shot. So in the following years, you won't have to go and get a flu shot in one arm and a COVID shot in the other arm. They'll be combined. And then over time, we're going to keep adding more and more respiratory virus like RSV to the combination as well, so that you can have only one shot early in the fall at the pharmacy, and then you have a happy fall, or in winter, you're not sick.
So, but this is for next year. This is not for this current flu season. Okay, got it. Just want to get clear on the timing.
You can still get your flu vaccine for this.
Well, I'm going to go down to LL2 and get my flu vaccine. I mean, who doesn't do that? But so with mRNA technology, what's it 3 to 5 years down the road? What do you expect that technology to tackle next, maybe?
Yeah. So we're announcing today at R&D Day that we should launch 15 new drugs in the next 5 years. 15 new drugs in the next 5 years. That's kind of incredible across cancer, infectious disease, and genetic disease. We're also working on autoimmune disease. Think arthritis, Crohn's disease, and so on. We believe we're going to bring 50 more drugs on top of 40 we have in development, 50 from the lab into the clinic in the next 5 years. Around 10 new drugs per year moving from the labs into development. So what you see here is a true platform. There has never been a platform in the biotech pharma industry. As you know, most drugs go to the clinic. Yep. They fail. 90% of the drugs starting a phase 1 will never get launched. 90%. If you look at Moderna, because of our platform, because mRNA is an information molecule, we are 3 out of 3 in vaccines. We are 3 out of 3 in rare genetic disease. Cancer, incredible improvements, and it's just the beginning.
All right, this is all because of the mRNA technology, and I have a funding question then. What happens if, the COVID vaccine revenues don't meet your expectations? Can you still fund that kind of growth?
Sure. I mean, if you look at it, we say that this year we should be $6 to $8 billion of sales, which is still a very significant number for turnover. We have $14 billion on the balance sheet that we got through the COVID sales over the last 2 years. And so we can fund around, we think, $25 billion of R&D growth by cash generating by the business and the balance sheet. And we will also not be shy to partner if we have to. We are obsessed about getting those drugs to patients, to the finish line. But if you look at, for example, with Vertex, we partnered for cystic fibrosis for an inhaled mRNA, getting to the lung of the kids that have cystic fibrosis by inhalation. We developed that technology. Yet another 4th cylinder for Moderna to develop a new family of drugs. And so that's what we're trying to do, is push the boundary of science, get more and more drugs. And if we have to partner, we'll partner.
But it's expensive to do. And, because of recent legislation, the United States, the Biden administration passed, the United States is going to not only negotiate prices with drug makers, but set prices with drug makers. Is that a concern to you?
Very much so. As the rest of the industry has voiced, you cannot set prices because R&D is risky. As we just talked about, 90% of drugs entering the clinic fail. Very, very high failure rate of the industry as a whole. If you start to set price and not look at value that is bringing by the drugs, you're going to reduce the ability of pharmaceutical and biotech companies to invest in innovation, and that's a big worry.
But they're going to set prices, so how are you going to deal with it?
So we just need to keep innovating and figure out ways to go after, smaller disease type, selling around the world, because again, the US, of course, is the #1 market in the world, but other markets are also very important, like Europe, Japan. And so we're going to have to grow internationally as well, but it's a big issue. I'm worried about it.
All right, how about, I always joke that in my next life, I want to come back as a healthcare M&A banker, because every Monday we come in and there's another healthcare deal that you or one of your competitors do. Is there something that you need to buy in the next couple of years to get to where you want to go that maybe is not in your pipeline right now?
No, what is cool about mRNA is we are the world leader in mRNA. Even BioNTech, which is a great company, they are doing small molecule, large molecule, a lot of different technologies. We are only doing mRNA. What we're doing through our BD activity is either buying. We bought a company in Japan over the Christmas break that has a cool technology to make our mRNA operating system stronger and bigger so we can do more drugs. We announced on Monday a deal in cancer with a company in Germany that has very cool science and biology that we can code into the mRNA molecule to do new drugs. So this will do to expand the potential of impacting patients.
All right, excellent to have you in here. Really appreciate it. And I know you're going to go on television in just a moment. So our listeners will be able to watch you with Alex Steele and Guy Johnson on the European close. Just a fascinating discussion and also a fascinating move in the stock, up 6.7%.
Yeah, about that. Stefan Bancel, thank you so much for joining us. Stefan is the CEO of Moderna. Again, the ticker symbol for you stock jockeys out there, mRNA. We appreciate that. Thank you so much. All right, looking ahead here at this market here, we are pretty much unchanged here. So, we're going to be very interesting to see how this market, but, Moderna, again, that stock, as you mentioned, Matt, up 6% today, down 37% year to date. So a little bit of a hangover there from probably some of those COVID runs back from the last several years. But it was great to get Mr. Bancel in here to talk about that technology, that mRNA technology. I should have paid attention in chemistry class more.
That's the most fascinating market news of the day. Now, other people would probably say, wait, didn't we get CPI in this morning? Weren't we all waiting for CPI? Hasn't everybody been, holding his breath to see what CPI is going to look like? And to me, the market reaction says, what is CPI? Like, who cares about that?
It's a nothing bagel. But for an economist, it's big deal, and
I would think that for everybody, I'm frankly surprised by the lack of market reaction or the fact that the market's gaining.
Well, we were talking.
We see inflation on its way up.
Auto insurance up 19%. Tom Keenan and I, we immediately thought of Matt Miller because he's got a whole fleet of cars.
I just got an angry text from my wife about some auto insurance policies that she opened up in the mail this morning.
Wait till you get to the Challenger with the Scat Pack. Good luck with that. Yeah. All right, Michael McKee joins us here. He's an economist. So this CPI data.
I can't save Matt, though.
Yeah, exactly. What's your takeaway, Michael McKee, from the CPI data we got today?
It is something of a non-event in the sense that the Fed has already decided what it's going to do pretty much for the month of September. But it does keep in play the idea of another rate increase before the end of the year. So that kind of takes out of the mystery of what the Fed would say and whether they'll take out that extra rate move they'd priced into the dot plot. Because there are some concerning signs, shall we say. The core went down, which was good news, but we did see housing go back up again, and we know home prices are rising. Obviously, energy and gasoline prices are rising. Airfares went up 4.9%, and that was not expected, but they do have higher fuel costs, and now they got to pay all these pilot contracts that they agreed to. So there are a number of things out there that could push inflation back up a little bit. Remember, on a year-over-year basis, we deal with base effects, so we're going to see it's not going to look as bad, but it'll be concerning to the Fed to see that month-over-month change.
All right, how do your friends at the Cowboy Bar out in Jackson Hole, how do you think they're going to take this
I think it's the
data?
$1 million Cowboy
Is it the
Bar.
$1 million Cowboy?
It's called the $1 million because there's every bar in Jackson Hole is a cowboy bar.
Well, we call it the Cowboy.
The Cowboy. Okay, so
Cowboy. If you're from Jackson, you know what that means.
It's the Cowboy, and you were up on the bar stools with your Fed buddies.
With the saddle, yeah, with Tom Keene and his bow tie.
Right. So how do you think your Fed buddies from the Cowboy Bar are going to deal with this?
Well, they're not going to like the fact that gasoline prices are up because they're all driving big pickup trucks, which suck down the gasoline.
But also, they only care about the core, right? The Fed only focuses on the core.
Well, the Fed does, yes, but I'm talking about the Cowboys.
I see. Okay, yeah.
The Fed's really cares about PCE, and PCE has been moving more slowly down than CPI, so it's still a concern for them, and they have to watch what happens over the next couple of months.
Have you ever done a shot ski, Paul?
No.
So at bars like this, typically, I've done one at the $1 million Cowboy Bar, as well as some bars in Taos and in the Alps. They take an old ski, and they sort of glue shot glasses to it at various points so that you and your buddies can all do a shot at once by holding the ski and knocking it back.
Now I get it.
Yeah.
I can see you doing that, can't you, Michael?
Yeah.
Yeah, and I can see you, Michael and Tom.
I would do it with McKee.
I have done that, but I was just reading about somebody, I'm trying to remember now who just got appointed to some big job and did a shot ski with a glass of water.
That's okay.
That's not like cool. Why did you make the effort?
Why did you make the effort? All right, so I mean, again here, I mean, it feels a little status quo here. I guess that's kind of what the market's telling us here. Status quo. You can this Fed could stay where they are.
We're all waiting for the dots, right? Next week, a week from today.
I'm just thinking that the one thing that may have changed is that there's not going to be, they're going to keep that dot in there, that extra rise, because they want to keep that in their back pocket as a possibility, given that there are some things that weren't great in this report. But we went into the day thinking that the Fed would hold in September 20th and that they would consider raising again November 1st. And I think that's where we still are right now, which is why markets can focus on other things.
All right, Michael McKee, thank you so much. We appreciate that. Michael McKee does all the economics for Bloomberg News, Bloomberg Television, all that kind of good stuff. Shot ski. How come I hadn't heard of that?
I did
that seems like right down my alley.
In Taos with my dad and my 4 brothers. So we found a very big ski. I think it was like an Olin Mark II, you know, from back in the day.
Remember the long skis we had back in the day?
Yeah, there used to be. When I learned, they were like, you're 6 foot, and change. Like, you need a 215, you know? And now my carving skis are like 175.
I know. And it's just a whole new way of doing it. But anyway, it's funny, when you're sitting on a chairlift and you see people coming down, you can tell people by their age about how they ski. It's just it's changed, but it's still fun. And Michael McKee out there in Jackson Hole with all the big players earlier. Right now, let's get our news, our world and national news in New York City with Michael Barr.
Thank you very much, Paul. Matt, escaped Pennsylvania convict Danilo Cavalcante has been captured by Chester County authorities this morning.
Chester County government and the various other agencies working on the prisoner escape are proud to announce the subject is in custody. Repeating, subject is in custody.
Sound from OpenMHC.com. Aerial video footage showed Cavalcante wearing a gray long-sleeve shirt with law enforcement officers holding both arms. Later, he stood at the back of an armored vehicle while an officer cut the back of the shirt from neck to waist. It ends a nearly 2-week manhunt that spanned most of Chester County as Cavalcante managed to evade authorities. Emergency workers uncovered more than 5,000 bodies in the wreckage of Libya's eastern city of Derna. Floodwaters smashed through dams and washed away neighborhoods. It's feared as many as 10,000 people are missing. Meanwhile, in Morocco, close to 3,000 people have been killed following the nation's most powerful earthquake in a century. Last-ditch search efforts continue to look for survivors after the earthquake struck late last week. Lee is still a major hurricane. Currently, it's a Category 3 system, but it is expected to be downgraded later today. John Cangialosi is a hurricane specialist with the National Hurricane Center. He says folks in New England should keep an eye on the storm and its track.
It will likely take a little wobble to the left. That is what our forecast is and what a lot of the models are showing. The big question mark is how much of a wobble to the left will it take? That still needs to be ironed out. at this point in time, we think that the focus of the impacts will be generally in northern New England and Atlantic Canada.
John Cangelosi with the National Hurricane Center. Global news 24 hours a day, powered by more than 2,700 journalists and analysts over 120 countries. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm Karen Moscow, and stocks are higher following that mixed inflation report. It's reinforcing speculation that the Fed will pause its rate hikes, but refrain from calling the end of its tightening cycle. And we check the markets all day long here on Bloomberg. The S&P 500 up 0.2%, up 10 points at 4472. The Dow Jones Industrial Average up 0.1% or 48 points at 34,696. And the Nasdaq up 1/3% or 51 points at 13,826. 10-year Treasury up 1/32, yield 4.27%. The yield on the 2-year at 4.99%. We did get word that crude oil inventories rose 3.96 million barrels, according to the EIA, and NYMEX crude oil is up 0.1% or 11 cents at $88.96 a barrel. COMEX gold little changed at $19.36 an ounce. The euro 1.0741 against the dollar. The yen 147.50. And the so-called core consumer price index, which excludes food and energy costs, advanced 0.3% from July. It was the first acceleration in 6 months, and from a year ago, it increased 4.3%, and that was in line with estimates. While we continue to watch American Airlines, it is down 3.7%. It slashed its third quarter forecast on a jump in jet fuel prices and higher labor costs. And Citigroup is up 1.6% as it prepares for a wave of job cuts as part of a restructuring. And that's a Bloomberg Business Flash. Paul and Matt.
All right, Karen Moscow, thank you so much. We appreciate that. I mean, the inflation print today, inflation's still out there, Matt. It's down dramatically from its peak, but I guess now it's at a spot where people kind of feel like it's sticky around this level. And the next, if you want to knock off on another 100 basis points of inflation, that's going to be harder work. To me, where I see inflation the most day to day is food.
Yeah, I mean, I don't really pay attention when I.
All right, here's my.
When I go to the grocery store.
Well, here's.
But are you talking restaurants or
both?
Yeah.
Just everything. I mean, everything. Like the New York Strip steak, which is my go-to when I go to like a New York steakhouse. 2-3 years ago it was $48, kind of standard across the good steakhouses in New York. That's now it's north of 60. And it ain't coming down again.
I feel like we go to different restaurants.
Well, I mean, every once in a while you treat yourself to a steak.
But I mean, to be honest, I pay the most attention to egg prices.
Yeah, well, so
which
does Ken Felio.
Recovered. Yeah, true. We're probably looking at different eggs. Like I want.
Well, he buys like 1,000 eggs
from somebody who gets each chicken its own home.
No.
Yes, I want the chicken to be treated right, and I've seen those prices come down for the highest quality, most pampered chickens. Those eggs were like $8.99 a dozen. I've seen them come down to $6.99 a dozen. But I see it for the most part in gas. I mean, we're up now, I think 12 or 13 cents higher than we were at the same time last year. So, but the bottom line is we got inflation out today. The headline number was more than it was last month. Year over year, we're looking at 3.7% rather than the 3.2% we saw last month. And the core number, the month over month number, inched higher from 02 to 03, but the year over year core number went from 4.7 to 4.3. So kind of a mixed picture there. And as a result, I think Wall Street is seeing this. Tom Keene this morning said it's nothing burger.
Nothing. Well, here's a note from Gina Martin Adams, who's our equity strategist for Bloomberg Intelligence, and she kind of answers the question: why aren't stocks reacting much to today's CPI quote unquote surprise? As far as the equity market is concerned, the inflation landscape shifted at the start of the year, i.e., it's going lower. And as long as PPI stays above CPI, it's status quo. So I'm going with that. So, all right, let's check in with somebody who kind of does this stuff for a living. Managing money. You got to be right more than you're not. Kara Murphy, CIO at Kestra Investment Management, joins us. Kara, what did you take away as a professional investor from today's CPI print?
Well, I think it was a little ho-hum, which is a good thing. We made a call earlier this year that inflation had officially jumped the shark. And, if you think back to when the Fonz on the Brady Bunch actually jumped the shark, people kept watching the Brady Bunch. It was still a good show, but it wasn't as good as it had been. Similarly with inflation, it's just becoming less of an important story than what it has been.
It is true. I think jumping the shark comes from Happy Days, Kara. That's
Oh, I'm sorry, you're right.
It was the
Brady Bunch
Fonz.
is another classic, though.
It was the Fonz, I believe,
Yes.
who was water skiing.
Yeah, with the leather jacket.
And jumped the shark.
Yes, yes.
All right, so what do you do here, Kara? I mean, we've got stocks. If you look at the S&P 500, had a nice turnaround this year. Yes, it wasn't as broad-based as a lot of folks would like, and so some people are suggesting, all right, kind of back away from some of those, high-growth tech names and maybe try to look at some of the names that haven't participated this year. How are you guys thinking about it?
Yeah, I think our view is consistent with that, and that it's been wonderful in that we've had some, really good strength from a narrow number of names. But in order for the market to continue going up, you have to see things broaden out. We saw, hints of that earlier this summer. Then the Big Seven kind of took over again. But we think longer term, it still makes sense to sort of look in areas of the market that are outside that very concentrated area that have led the market in the first half of the year.
So, how much does the Fed play into this? I mean, we're looking at this inflation number from this morning. We don't think it's going to do much. Wall Street doesn't think it's going to mean much to the Fed. But Mike McKee says they may leave that dot in there that represents one more interest rate hike this year. Does that matter?
I think the terminal rate for the Fed funds rate, so whether the Fed hikes another time, 2 more times, I think that is much less important than how long we stay at that terminal rate, right? Because the longer that we stay at this high level, the more loans that come due and the more it starts to eat out of corporate profits or, individuals' pockets. So I think for me, like listening to the Fed at the next meeting, it's going to be more important to think about that longevity of high rates. And what we've seen is that the market has consistently been pushing out the time at which the Fed starts to cut rates. Now we're looking at about the middle point of next year. And the longer it takes, the more and more impact we see in the overall economic growth.
How about small cap stocks here, Kara? It just seems like it's never the time for small caps. How do you guys think about small cap names?
They have really been taking it on the chin. Again, we saw like some small signs that small caps were outperforming relative to, say, the NASDAQ earlier this summer, and then they've retreated again. We do think that, this world of the Big Seven can only last for so long. And what that means is that, mid cap and small cap names start to come back a little bit more in favor. But it's been hard, right? They've been pretty beaten up over the last couple of years.
So, are there any specific sectors in small caps that you like?
So one area that we've been looked at in general, kind of across the market cap spectrum, is in industrials. That is a sector that, from an economic perspective, got hit fairly early on. The sort of like post-COVID retreat from, a lot of the durable goods buying and whatnot impacted industrials. Industrial production really slowed down earlier this year. But it feels like industrial production is sort of bottoming out. And then when you look at valuations in those sectors, that is one area where you can see much lower valuations relative to where they've typically traded historically, unlike some other areas of the market. So we think there's value there, and there's a good sort of rejuvenation of growth that can help drive those names.
So what am I doing in credit? Do I actually go out and try to overweight or just increase my exposure in the fixed income space?
So credit is an area where we're more cautious. If you think back to this discussion of the Fed, you have rates that are higher potentially for longer. The longer they stay there, the more debt that needs to get refinanced at these high levels. So if you think about high yield companies, they're particularly susceptible to these higher rates. And so as those companies start to see their debts come due, it's going to take a much bigger sort of chunk out of their regular profits. And then on top of that, you're seeing really, really tight credit spreads. So this is not something that the market is terribly worried about right now. So that's an area where we don't feel like you're being paid to wait as much as we would like.
All right, Kara, thank you so much for joining us. Kara Murphy, she's a CIO at Kestra Investment Management, giving us her thoughts on these markets. And again, a little bit of a lift here to the markets. The S&P up about 0.2%, the NASDAQ up about 0.3%. And looking at the yields, kind of steady. 10-year Treasury, 4.28% on your 10-year. The 2-year, spot on 5%. That's not a bad place to be for a couple of years, getting 5% on your money, given what we all had to deal with in 2022 when there's no place to hide equities or fixed income. Bitcoin, that's up a little bit today. How about that? This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Good morning, Paul. A major car maker says fully electric models are becoming harder to sell, so it's making a change. Bloomberg's Gina Cervetti reports.
Ford says is seeing growing demand for the gasoline-electric hybrid F-150 pickup, so the company plans to slash prices and boost production of the vehicle. Ford says it will offer the gas-electric hybrid F-150 starting at $55,000, the same price as its gas-fueled model. Buyers are turning to hybrid trucks instead of fully electric because they offer a way to reduce fuel consumption while still having the power to tow.
And shares of Ford right now up more than 2.5%. China is finally acknowledging reports about iPhone bans. Bloomberg's Ed Ludlow has more.
What is really important with this story is that the spokesperson, Mao Ning, went on to say that China has not issued laws and regulations to ban the purchase of Apple or foreign brand phones. And actually, if you look across the media landscape this morning, many outlets leading on that there is not, according to this spokesperson, an outright ban.
Now, that spokesperson did add that the government does attach great importance to security, and all companies operating in China need to abide by its regulations. Shares of Apple right now, they're down about 0.7%. Meanwhile, a government watchdog agency in France has ordered Apple to pull the iPhone 12 from the French market. The National Frequency Agency, it says it emits levels of electromagnetic radiation that are just too high. It's asking Apple to fix the issue. Now, Apple says the device complies with all regulations governing radiation. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets, we have the S&P 500 up 0.25%, NASDAQ about the same there on the back of that CPI print we had this morning, showing a little bit higher inflation in the core inflation data, but the markets seem to be taking it in stride. Yields basically unched on the day with the 10-year giving you a 4.28%, 5%. I like that number on the 2-year Treasury. We'll keep an eye on that. With our news in New York City, here's Michael Barr.
Thank you very much, Paul. Matt, they got him. Pennsylvania State Police say escaped murderer Danilo Cavalcante has been captured after an extensive search. Cavalcante broke out of a prison in Chester County 14 days ago. Pennsylvania Governor Josh Shapiro.
Thank God there were no injuries to law enforcement or to the public. We obviously became deeply concerned after the suspect was able to steal a weapon. He was apprehended this morning with no shots fired.
Former FBI agent Brad Garrett says many recent developments likely help police get the final push they needed to ultimately track him down.
The two things that probably, or three things that got him caught, one is his exhaustion. Two is I think they were really able in the last 24 hours to narrow their search perimeter. And it sounds like that they got a tip. In other words, I just saw him, he just entered my garage, whatever it might be.
A law enforcement official says authorities used thermal imaging from aircraft to pinpoint and capture Cavalcante. North Korea's Kim Jong-un vowed full and unconditional support for Russia's Vladimir Putin. Two leaders held a summit in Russia that the U.S. warns could lead to a deal to supply ammunition for Moscow's war in Ukraine. A story now about sinus medications that have been on the market for decades. An FDA advisory committee found over-the-counter oral phenylephrine, or PE, does not alleviate nasal congestion because it's processed by the body before it reaches the nasal passages. PE is one of the ingredients in such things as Sudafed PE and Mucinex. Dr. Purvi Parikh is an allergist at NYU Langone.
This ingredient, phenylephrine, is in so many different cold medicines. That's why it is important to kind of educate yourself on what to look for and just avoid that ingredient.
Dr. Parikh says that although the nasal sprays are much better with PE because they work and are considered to be the better option. Global news 24 hours a day, powered by more than 2,700 journalists and analysts over 120 countries. I'm Michael Barr, and this is Bloomberg. Paul Matt.
All right, Michael Barr, thank you so much. We appreciate that. Bloomberg Business Week out with its rankings of top business schools, MBA programs, and the folks in the MBA world highly anticipate this issue every year. Headline, number 1, Stanford. Number 2, Chicago. And tied for 3rd, Dartmouth. And I think there's a little bit of a surprise. Our good friends down at the University of Virginia. Harvard comes in, Harvard Business School at 6. A little surprise there. University of Pennsylvania's Wharton School, number 8. And then my Duke University, 14. And I know the folks down in Durham, North Carolina at Duke are not going to be happy with that because we like to think of ourselves as a solid top 10, maybe top 5. But these are some rankings.
Well, this is exactly. I mean, there are different rankings from different sources. This is Bloomberg Business Week's B School ranking.
I think that's kind of the number 1 in terms of just kind of what people pay attention to out there.
In terms of rankings, Business Week ranks the best ranker.
Well, I just think it's the most notable one, and I'll tell you that it's the folks at these schools highly they highly anticipate these things because if you're, especially for international students, if you don't know that much about the United States business schools, one of your first places to go is just the rankings, the simple rankings. I'll apply to the top 5, the top 10.
If you click into the rankings, you can see different areas.
Yep.
Do you want to go to a school with the most diversity? Do you want to go to a school that has a focus on entrepreneurship or networking? Do you want to learn more, or do you want to get paid? In terms of compensation, Dartmouth ranks number 1, then Columbia, Chicago, and Virginia.
Yep. So the rankings are out. Bloomberg Business Week magazine, highly anticipated for the folks in that MBA world. This is Bloomberg.
Yeah, why don't we have that on the rankings?
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Kaylee Lyons, Bloomberg television host. She's down in Washington, D.C. She's going to join us from the Senate hearing on AI with the top leaders in tech. Let's see how that's playing out. Plus, Encore Crawford, Executive VP and Portfolio Manager at Alger, is going to talk markets with us. And then on the macro view, Rob Conzo, CEO of the Wealth Alliance, talks about markets and outlooks for the economy. But let's kick this 11 o'clock hour off with Mr. Charlie Pellet.
All right, I thank you very much, Paul. And we've got the Dow, the S&P, NASDAQ all pushing higher. Best level of the morning right now on the S&P. CPI Wednesday and right to the numbers. The S&P up 12 now, a gain of 0.3%. The S&P at 44.74. The Dow's up 83, up 0.2%. NASDAQ, the composite index, up 48 points now, higher by 0.3%. 10-year yield 4.27% with a 2-year 5.00%. Spot gold down $1 the ounce to $19.12, and right now we have got West Texas Intermediate crude 89.18 a barrel. WTI up by 0.4%. Brent, the global benchmark, holding above $92 a barrel, up now by about 0.3%. Underlying inflation ran at a faster than expected monthly pace in August, leaving the door open for additional interest rate hikes from the Fed. The so-called core consumer price index, which excludes food and energy, advanced 0.3% from July, marking the first acceleration since February. Reaction to this morning's CPI data from Torsten Slok, chief economist at Apollo Global Management.
We see still a number of areas where inflation is certainly coming down, but most importantly in services, there's still a number of question marks. In particular, you have a number of areas where you still see inflation moving up. Yes, this is so far so good, but all these numbers, which are 3-4%, are still above the Fed's 2% inflation target.
And you can hear more of the conversation with Torsten Slok on the Surveillance podcast. You can download it wherever you get your podcasts. Citigroup is preparing for a wave of job cuts as CEO Jane Fraser restructures the Wall Street giant to operate from 5 main businesses. Citigroup shares are up now by 1.6%. Again, recapping, stocks are higher. The S&P up 10, up 0.2%. 10-year yield 4.28%. I'm Charlie Pellet. Matt and Paul, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. So, Matt, apparently some of the big tech CEO mogul types are in Washington, D.C., and they're meeting with a bunch of Congress.
Like an AI meeting.
Yes, talking AI. I mean, how simplified did they have to make it for these folks? I mean, they're going to have to say
for Washington, yeah. I mean, even for you and me, I think just the broad strokes, executive summary would be fine.
Just fine.
But it'll be, I think, fascinating because Elon Musk is apparently there, and the guy from OpenAI is apparently there. So
some heavy hitters. Yeah. You know who's also there? Kaylee Lyons from Bloomberg Television. She's down there in D.C., and she joins us now. Kaylee, I would love to be a fly on the wall in this meeting here. I know Chuck Schumer, the senator from New York, is kind of arranging this thing, I guess is the word.
Is it a closed door meeting?
I think it's tell us about this meeting, Kaylee. What's going on?
Well, it is a closed-door meeting, you're right, and there has been a bit of controversy around that. You have senators like Josh Hawley, who was actually just out here near the rotunda speaking to reporters, saying he is boycotting this summit because it is closed-door, and that's on the Republican side. On the Democratic side, you had Senator Elizabeth Warren with a lot of criticism on that as well. She said that this shouldn't be closed-door. They should hold a public hearing so the public can hear what all of these individuals have to say and that senators can ask questions. Now, Senator Amy Klobuchar did tell some of our colleagues here at Bloomberg that senators did have a chance to share questions with Schumer that may be asked in the meeting. But right now, what we know is that there's 22 individuals in there. They range from billionaires, big tech CEOs, to union representatives from the likes of the teachers unions or the AFL-CIO. And they're each giving a few minutes of opening remarks. And then we understand that Schumer is going to moderate a bit of a conversation from there. This current session they're in goes until 1 p.m.
So is the idea here to try and get the folks in Congress to either support the industry with various stimuli or to regulate the industry with various oversight rules?
Well, what the organizers of this, from Chuck Schumer, the, of course, majority leader in the Senate, to the Republican Senator Mike Rounds of South Dakota, who also helped organize this, is that they are just trying to hear from them. They want to hear as much as possible in a very short period of time. Mike Rounds told me yesterday they're going to take what they hear with a grain of salt, but still it's about starting the conversation. And Senator John Cornyn actually just walked out of the room and told reporters that it was pretty much a very general discussion from Musk and Zuckerberg and the others. He said the fact that this meeting occurred might be more important actually than what's being said. But we do know from sources in the room that my colleague Anna Edgerton is speaking with that some of them are voicing concern potentially about the regulatory path forward. The CEO of IBM saying that an AI licensing regime would be a serious blow to open innovation and risk creating a form of regulatory capture. So certainly some conversation about what the regulatory regime should look like going forward is being had in there.
So is this a bipartisan meeting today, or and I'm wondering who got invited and who didn't, and how that kind of plays out, as you mentioned?
Well, if you are a U.S. Senator, you were invited to this meeting. Again,
Okay.
not everyone is going. Senator Hawley's sitting it out, but there are the majority of senators that have been filtering in and out of the room today. It is bipartisan. It's being co-hosted by both Democratic Senator Chuck Schumer as well as other colleagues on the other side of the aisle. When I spoke with Senator Mike Rounds yesterday, he said the effort is bipartisan. They want to keep it that way. We know there is not a lot of issues here on Capitol Hill that you can get the two sides to agree on, but the idea that you need to do something on AI is one of those few.
What is the feeling in Washington, just broadly speaking, Kaylee, as it relates to AI? Do the folks have an appreciation for how important this is, how pervasive this technology can be? What's the feeling in D.C.?
I would say the appreciation is there, the understanding maybe not so, and that's part of what today is about, just trying to get more information on this technology that is moving at a far quicker pace than, frankly, anything here in Washington moves. So there is an understanding that there should be guardrails put around this, that this is technology that's going to shape the future, and as a result, Congress has to pay attention. How quickly Congress will actually do anything in that regard to try and shape what the regulatory regime is going forward, what that timeline looks like, that's an entirely different question. Of course, the understanding gap here as well. As we know, there is a certain age of a lot of senators, and they're not the most tech-savvy individuals in the world, which is probably what a lot of the CEOs and others are here to do, is educate first and foremost.
I wonder if there's a partisan split similar to that we see around crypto. Because you do, in some ways, see Democrats pushing for more regulation in that area and Republicans pushing for more of a laissez-faire approach. Do you see that around AI as well?
Yeah, that's an interesting idea, Matt, because of course, usually on the Republican side of the aisle, it is for fewer guardrails, right? To let business be business and let companies innovate, while it's Democrats that are pushing for stricter regulation. I think at this point, there is still such an effort to even get their arms around what exactly this technology is that you aren't necessarily seeing a partisan divide taking shape in the same way. Everybody seems to agree that you need to do something about it. I would say another factor that informs that thinking on the part of lawmakers is the idea that this also is about competing with China. We understand, according to a source in the room, that China was something that came up in Elon Musk's opening remarks, that this, at the end of the day, is about competing with the Communist Party of China, and that is also a concern that unites a lot of lawmakers. A lot of people are China hawks here in Washington.
All right, Kaylee, thank you so much for joining us. Kaylee Lyons, Bloomberg Television. She's down in Washington, D.C. at the meeting of these tech moguls and various members of Congress talking about AI. I'd love to be a fly on the wall there. All right, Matt, you know how I love to look at people's educational backgrounds and how they apply them to their jobs. Our next guest, this is great. BS in both mechanical engineering and materials sciences and engineering. So I'm immediately not talking to that person at the cocktail party. And that's from University of California, Berkeley, so they know what they're doing out there. Then you go get a master's and a PhD in materials science and engineering from Stanford.
They're pretty smart.
They're pretty smart.
Yeah.
So what do you do with that? You go trade stocks. How does that work? I mean, it's just amazing what people do. Ankur Crawford joins us. She's a portfolio manager and executive VP at Alger. Ankur, thank you so much for joining us here in our Bloomberg Interactive Broker Studio. I just love looking at people's, kind of how they kind of came up through the business. So, but you've been at Alger since September 2004. So you've seen some market movements. What are you guys at Alger doing now? stock market's up double digits this year. We've had a little bit of a bounce back off of an ugly 2022. Now what do we do?
Yeah, I think it's not going to be quite as easy as it has been over the last 9 months.
Okay.
And we're going into choppier waters. And in part because we're just waiting for the economy to respond, and we just don't know the magnitude of how it's going to respond. Is it going to be a soft landing, hard landing, no landing? And I think no landing is coming off the table. I think the expectation is now for soft landing, and there's arguments for hard landing. So I think because of that uncertainty in the market right now, the consumer resilience is starting to taper, the job market is starting to come off a boil. We're going to see a choppier market.
Does landing imply cuts? I mean, in a hard landing, clearly you'd think the Fed's going to cut because that means we're in a bad recession. I don't totally know what soft landing means in terms of a Fed reaction but do they cut or, I know what a soft landing is like in terms of an airplane. I'm just saying, like, when you come down, right, and just set it down gently, I guess growth doesn't contract, but it's also not expanding at a massive pace. And does the Fed then cut, or do they leave rates higher for longer?
You know what? And that's the risk. They could actually leave rates higher for longer in that scenario. So it's funny because the people that believe that the Fed is going to cut and they're excited about the Fed cuts, I look at them and say, well, you know what? First, the economy has to get really bad if they're going to cut at this pace.
I will warn you that Paul thinks that we're going to have a nice soft landing and the Fed's going to cut.
Yeah, I'm a former equity analyst. I'm very optimistic.
Oh, tell me why.
Yes, exactly.
A former equity analyst with a floating rate mortgage. So he would like to refi,
Maybe that's wishful thinking. Then.
I know. I've been accused of that before. All right. We were just talking to Kaylee Lyons from Bloomberg Television. She's down in D.C. kind of reporting on this AI thing in Congress. How do you guys at Alger view AI? Because you could argue that's been a big driver of the performance this year.
Yeah, we are very, very bullish on AI. We've been bullish on AI, and we think that Gen AI and what we're seeing with these LLM models,
large language models, right?
The large language models that are democratizing.
Using your PhD in engineering.
I like it.
See?
I like it.
That it's basically democratizing technology, and it's going to create a step function up in adoption rates for all kinds of businesses, through healthcare, industrials, tech. So highly bullish on AI. The adoption is going to be, we think, 30 to 40% by the end of this decade. Which is in any kind of industrial revolution that we've seen, it's the fastest adoption rate we're going to see.
But will it hit the labor market? I mean, right now we saw unemployment come up to like 3.8%, right? Yep. But that was all because more people were coming back in. So it's still a very tight, very strong labor market. That's what we hear. Is AI going to displace a lot of jobs by the end of the decade?
I think it's hard to say, but just before we move on to AI, on the unemployment and employment, Walmart and Best Buy, both at the conferences this week, indicated that Walmart, we know, is taking down starting wages for jobs.
They're taking down
wages? They're taking down wages.
Really?
Best Buy indicated that, maybe they would do low single digits or worse than low single digits, which would be, we think that means zero.
Right.
So wage growth is now starting to come off a boil, which is the first indication in the economy that employment's starting to turn.
Interesting. So you see the labor market kind of flagging a little bit.
Yeah, so if you look at hours worked is coming off its peaks. It's been declining for a year and a half. Hourly wages, right now it's still rising. I think we start to see a moderation. But that's just on the employment side. So as for Gen AI and what the impact will be, what we're hearing right now is companies that are deploying Gen AI inside of their own businesses today, they're not firing people, but they don't have to hire as many people because productivity is increasing. So does it change the composition of the labor market and the demand for labor? It might. But what it means that we're going to have to retool. We're going to have to retool our economy and our workforce.
Oh boy, that's just what a lot of folks want to hear, right? First they got jammed by people jobs going across seas. Now they have to do this whole worry about AI. All right, when I think of Fred Alger Asset Management, or Alger, I think growth investors. where are you guys looking? What sectors are kind of interesting to you? We mentioned maybe tech and AI and that type of thing. Where else are you guys looking for opportunities?
You know, I think when people think of AI and investors think of AI, they automatically say NVIDIA or Microsoft. And yes, we are big holders of both Microsoft, NVIDIA, and the common AI platforms. But what they forget is that in order to deploy all of this AI, we also need to be, we need to build data centers.
Okay.
There are no data centers. Data centers are full. We need electricity.
Is that so? Data centers are full. Where are the data centers and why are they full?
Well, in part, they're full because there's no electricity going to the data centers. And so there's going to have to be this CapEx cycle that supports the utilities to provide electricity to the data center. And so, there's a lot of interesting names, like Quanta PWR, or, we have an investment in a company called Virtus, which is a cooling company. And so they basically, they provide widgets into a data center, and one of those widgets is the new cooling mechanism that you're going to need for these Gen AI servers. So there's
Digital Bridge.
There's different ways
Mark Ganzi's. Yeah.
There's different ways to play this trend in industrials and other parts of the economy that we're also focused on.
That's interesting. We did a big story about Mexico and how difficult it is to be reshoring there because they just don't have the infrastructure.
Is that right? Okay.
Right? Yeah. And I guess the same problem faces generative AI because you need to have a lot more giant server farms set up to run all the NVIDIA chips that are getting ordered.
Well, don't we have a lot of flyover territory that put a big server farm out there?
Yeah, but you got to put it up. I mean, it takes money, right? You need the bulldozers. You need all the CAT equipment.
Yeah, that's what we're talking about.
And you got to put in the computers. So,
are you concerned about valuation in this marketplace? Because a lot of folks say, hey, if you strip out the Magnificent Seven, this market's not so expensive. How do you guys think about valuation?
So we kind of do it as a sum of the parts, and we look at the components. So you look at Microsoft. Microsoft currently trades at, granted you have to look out to 2025 when they have a full blossoming of their AI, or at least they're on way to that. It trades at a high teens multiple. You look at Meta. Meta trades at a mid-teens multiple. Google at a mid to high teens multiple on 2024 numbers. So, there are portions of the market, big portions of the market, that actually don't screen as having necessarily an egregious valuation. Look, now there's other portions of the market that, one can say, the growthier stuff that has worked this year. Could it pull back? It could.
Okay. Ankur Crawford, thank you so much for joining us. Really appreciate it. Ankur Crawford, she is a portfolio manager and executive vice president at Alger, the asset management folks. Some good folks there. I've known them.
And a doctor and an engineer.
I know. This is Bloomberg. Let's get some company news right now. Lisa Mateo.
Thanks, Paul. Moderna could be on its way to seek regulatory approval for its flu shot. The company said a reformulated version of its messenger RNA-based influenza vaccine met its primary goals in a final stage trial. And the reformulated vaccine produced a stronger immune response against all 4 strains of the virus than a traditional flu shot. Moderna shares right now, they are up about 5%. U.S. health regulators issue warnings about unimproved over-the-counter eye drops. More from Bloomberg's Steve Rappaport.
Lisa, the FDA considers some eye drops sold by CVS, Walgreens, and other companies to be unapproved new drugs that are illegally marketed. The agency in warning letters says those eye drops pose a public health concern because they were manufactured by companies known to have quality control issues related to product sterility. CVS and Walgreens say they've stopped selling the products in question and offered refunds to customers who purchased them.
Shares of CVS right now, they're up about 0.3%. Walgreens shares, they're down about 0.8%. A ride-hailing service wants to improve safety for its customers. Bloomberg's Kimberly Adams has that story.
Lyft is launching a feature that will let women riders request women drivers in response to demand for increased safety protections. The company says 23% of its drivers are women, but account for nearly half of its riders.
Lyft shares right now up about 0.2%. And Amazon delivery drivers will be getting raises. The e-commerce giant plans to invest more than $440 million next year so its delivery service partners can provide higher wages and more benefits. Amazon expects drivers will be earning an average of $20.50 an hour. Shares of Amazon right now up about 2%. Those are the company stories we're following. I'm Lisa Mateo.